Okay, let's get started here. So hopefully everyone has the model downloaded and you've just been playing around, poking around, looking at the model here. And so I'm going to share my screen and we're going to get started working on this together. And so again, if you don't have it already, I'm going to drop this link into the chat one more time and make sure that everyone has it accessible. And then if you do have access to it, then you should be good to go. And so I think everyone should have access to it. Make sure to ping me if you don't already, and then let's get started. So today we're going to be doing, again, three things primarily. We're going to be building an income statement, we're going to be building balance sheet, we're going to be building a cash flow statement. And beyond that, we're also going to talk a little bit about how to collect the sources and how to actually create some of the outputs that we're looking at. So let me just share my screen here and let's take a look at this financial model. So let's orient ourselves to start with. And I'm just going to illustrate some of the good modeling practices that we have while we're working on this. So first thing that you're going to notice is we've got a cover tab. This is a good practice in all financial models where we basically just describe a little bit about what's going on. You can see we've got some instructions. You can see that we've got a little bit on like color coding and things like that. We're going to make the hard coded numbers blue. We're going to make the links green. We're going to make the inconsistent or bad formulas red. We're going to make everything else that's like an actual formula, we're going to make that black. And so that's going to be a really important thing for each of you to pay attention to on the formatting side today. And then the next thing you're going to notice is we've got some sections down at the bottom. Highly recommend building sections like this. You can see that we've got a sources section, we've got a model section, we've got an output section, and then and that's kind of the key pieces. And then we've got like a couple key concepts things. And so you'll have access to some of those tables that I was showing you there on the right. Okay, so great. So let's look at this. Look at this first. So the first thing that we're going to do is we're going to dig in and start collecting the sources, the income statement, the cash flow statement, and the balance sheet. And so for those of you who are on the desk in investment banking or private equity or something like that, where is this actually going to come from? And so I'm gonna like write this down. So where does this come from? And so the first place that this comes from is from Capital IQ or FactSet. These are the two most common data services providers that basically have all of the stuff that you need for like a company's financial information. It's got their income statements, it's got their balance sheets, it's got their cash flow statements. Historically, it's got stock price charts, it's got shareholder analyses and things like that. And so that's going to be probably your best bet is a data services provider like CapIQ or FactSet. The second tool set that you're going to be using is what I use today for this, which is BAMSEC, BAMSEC. And that's basically a tool. I'll show you what that looks like in just a second here, that basically enables you to pull all of the financials that you need for a company very quickly and download them directly into your Excel. The third thing that you can do, if nothing else, is SEC EDGAR. And so this is basically this SEC, like the government agency's actual public filing source that you can go look up. It's totally free. It's a little bit clunky, which is why third-party tools exist, but enables you to get all of the financial information that you need about public companies for free. Okay, so that's basically the three main pieces of data. And I also just wanted to call out again, if you don't have the Excel keyboard shortcut cheat sheet, it's in the folder that I dropped in the chat. And so you should have access to that already. But if you don't have access to it, go ahead and grab it there, and I'll call out some of the keyboard shortcuts I'm using as I go. So let's look at where this information actually comes from. And so what I'm going to do is I'm going to click on the source in this file, and I would encourage each of you to do that as well. And so I'm going to look at the source here. I'm going to pull this open, and then I'm going to reshare my screen so you can see what this looks like. But basically, it's going to take us to a website called BAMSEC, like I was mentioning, that has all of the company's financial statements here. And so let's go ahead and orient to this. And I'm teaching you like actual practical skills that you're going to use on the desk. This isn't just like theory. This is like what actually is going on here. And so I'm going to share my entire screen, and you can see that on the left side here, I've got the financial model. And then when I clicked on the open, it gives us the Sentinel-1 side of things. And so let's take a look at this. Let's see what we've got going on here. So this, when I clicked on the link, it took me to the actual financial table here. And so I'm going to open this up a little bit. I'm just going to expand that. You could do Windows up arrow key for that. And you can see that this is basically the 10K for the business. And so let's go poke around in the financials and understand like what the financials for a business like Sentinel One look like. And so I'm just going to click the back button over here. And it's going to take us to the Sentinel One homepage. And so you can see that basically what BAMSEC does is it pulls all of the 10Ks, all of the 8Ks, all the prospectuses, all the proxies and things like that. And you can go through and click through the latest models. And so the most important one for what we're doing today will probably be this fiscal year one. I think since we built this model a few months ago, we might be basing it off of the fiscal year 2025, but let's go take a look at like what's in the fiscal year 2026 one. And the first thing I'll have you note on this is that the fiscal year ends on January 31st for this company. And so most companies, as you know, have a 12/31, like December 31st fiscal year end. Sentinel One's a little bit different in that it has a January 31st fiscal year end. And so that means that the fiscal year end just ended a couple months ago for 2026. And so it's a little bit counterintuitive, but the 2026 year is already over for Sentinel One. They could technically end their fiscal year 2026 on like January 1st or January 2nd or something like that. But January 31st is also pretty common. Okay, so in the 10K, we're going to have all of the financial information that we need to build out the financials. So remember earlier how we were talking about income statement, cash flow statement, balance sheet? This is where you find that. And so this is going to be in the section that says financial statements and supplementary data. So if you scroll down, you've got this nice little cover page. It says what the stock symbol is, blah, 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 New York Stock Exchange. Great. Awesome. Share count. You need that at the bottom here. And then you scroll into the table of contents, and then you can go to the financial statements and supplementary data. And so then once you scroll down, you've got our balance sheet here, which is the assets, liabilities, and equity. And so remember, I showed you this earlier on PowerPoint. I made it way simpler, but this is what an actual balance sheet looks like. And sometimes it gets even more complicated than this. This is a relatively simple company in terms of the financials. So that's the balance sheet. The second one is the consolidated statements of operations, which and loss, which we can kind of like skip over a little bit. That's it's not a very common statement, we can skip over we can skip over, let's see if they have like a normal income statement. Okay, nope, actually they don't have a normal income statement. They've got it split up into like these two sections here. They've got the statement of operations and the statement of comprehensive loss. The statement of comprehensive loss here, you can ignore this one. This almost never comes up except in like advanced accounting exams. The consolidated statements of operations, this is their income statement. You've got the revenue, the COGS, the gross profit, the OPEX, and things like that. This one's a pretty simple income statement. Like there's really should be like a lot more detail. And at various other places in this document, we can find like breakdowns of the revenue and breakdowns of the COGS and breakdowns of the OPEX and things like that. But this is just the simple version that's in the like main financial section. And then the third one here is the stockholders' equity. We don't really talk about this statement very often, but it is a financial statement. And then the fourth one that they've got here is the cash flow statement. This is the one that we also really care about. And as you can see, this one's actually quite detailed. They've got a lot of different breakdowns of the different net working capital items and the cash flow items and things like that. And so one of the key misconceptions that a lot of students have is that there are just 3 financial statements. There's actually more, including things like the statement of stockholders' equity. The 3 that we care about, though, again, are this balance sheet here, this very abbreviated income statement. Hopefully we can find more data. And then the cash flow statement here. So that's how you collect information. It's on a site like BAMSEC, and then if you get good at it, you're able to usually like actually go ahead and download this. And I'm not logged in right now, but if you're logged in with your school account or something like that, or if you're doing this a lot, I would use a free trial or like actually pay for it. I don't get any commissions or anything like that. It just saves a ton of time. And so you can download it and you can merge it. Now, for your sakes, I already did that for you. So I clicked download, I merged together a couple of years. And so let's hop back over into the Excel and you can see where this information came from. And so I'm going to pull this up side by side with the other screen real quick. So you can see what this looks like. But like, let's go back up to the income statement here and take a look at this. So if we've got the income statement, cash flow from operations, okay, there we go. Let's take a look at this one right here. And so the first thing you want to do just to like double check this is look at the same time frame. So this is 12 months ended January 31st. And like I suspected, this was built based off of the fiscal year 2025 10K. And so we're not going to be able to match up these 2026 numbers. We're only going to be able to match up these 2025 numbers. And so on the 2025 numbers, you can see that here, and let me just move my Zoom window. You can see in 2025 that was 821,461 of revenue. And yeah, that matches up here. And so you can see that the 2025 and 2024 numbers match up on the revenue. And this was basically just pulled down from there. And if we wanted, we could also go through, check the cash flow statement, check the balance sheet to make sure that those match. And I'd encourage you to do so. But what you'll find is basically that, yeah, I just downloaded it from BAMSEC and got it here. If you have CapIQ or FactSet through your school, go ahead and use those to double check as well. But does this make sense? I'm just going to stop for a second. Does this make sense how I got the information to begin with? Like, do you feel comfortable that if you're in a stock pitch competition or you're in a modeling test, could you go and get this information yourself for a public company to start building the model? Ask yourself that. That's a legit question. So feel free to pop it up. Yeah, Raul.
Yeah, I have a very small question. So let's say if anyone doesn't have, let's say, paid access to Capital IQ or BAMSEC, like are there any freer versions which we can use for downloading the 10Qs and 10Qs or the entire financial information?
Yeah. So first off, I would just like create a free trial with BAMSEC.
Okay.
And you can use a different email each time you need to like download stuff. It's a pain in the butt, but the other alternative to it is you can literally just what you can do is you can like take this table and copy it, hit Control C, and then go and like pop that into the Excel and like format it. It'll take you a few minutes of formatting, but that's free. The other thing that you could do with the advent of LLMs role is you could just like paste a screenshot of this into your like into Claude Code or something like that. And then it would just basically be able to like translate that into a financial model for you.
Got it. Thank you.
Yeah, absolutely. Any other questions on that? Okay, great. Well, in that case, then let's hop back over to the model. I'm going to change my screen share so you can see the Excel in more detail here. Okay, great. So that's going to get us the information. Let's go take a slightly deeper look at like what's actually going on here. So on the income statement, what you can see here is we've got the revenue, we've got the COGS, we've got the gross profit, we've got the OpEx broken down to R&D, sales and marketing, and G&A, restructuring, and then also total. So it sums up the operating expenses, and that gets us the loss from operations. And so this is more or less equivalent to like our EBIT. And then we've got interest income, interest expenses, other income and expenses, loss before taxes, taxes, net income. And so this is like our net income, and then you got like share counts, and then you figure out like earnings per share and things like that. And so that's the topography of the income statement. Let's go look at what they've got in the cash flow statement. So first off is this cash from operating activities. You can see that this is by far the biggest section because the cash from investing activities doesn't start till down here. And so all of this stuff is operating stuff. So we've got the net income, we've got adjustments for like depreciation, amortization, deferred contract acquisition costs, non-cash operating lease costs, stock-based compensation expense, accretion of discounts. And so you can see all this stuff that we didn't really talk that much about. These are non-cash add backs or deductions meant to reconcile the net income to actual cash. And if any of you are freaking out a little bit right now, I remember I was too the first time I built a model because you talk about it in theory and it's like, oh, cash flow from operations, it includes inventory, it includes net working capital, it includes depreciation. But in reality, as you can see, it gets a lot more complex than that. There's random things like amortization of deferred contract acquisition costs and stock-based compensation expense and accretion of discounts and amortization of premiums on investments. Like, what is that? Well, that's stuff we can talk about, but that's probably a little bit more complex than we're trying to get right now. So just know that each of these has a reason for being on here, and that in real life, yeah, these financial statements do get more complex than they appear in the presentation I was just building. And that's part of why they pay you $200 or $250,000 straight out of undergrad to build these financial models. Okay, so then second section here is the investing activities where we've got PP&E, we've got purchase of intangibles, capitalization of internal use software, investments, all that good stuff. And then we get to cash flow from financing activities. So we've got repurchases of options, proceeds of exercise, proceeds of issuance, net cash. And then at the bottom, we can basically see, okay, what was the change? What was it at the beginning of the year? What was it at the end of the year? And so you can see that for 2025, they start out with 300 million of cash. They ended at 200 million because they lost about 100 million. Okay. Next up is the balance sheet. So what do we got in the balance sheet? Well, we got your assets equals liabilities plus equity. And so on the asset side of things, you've got current assets, which is cash, short-term investments, accounts receivable, deferred contract acquisition costs, prepaid expenses. So that gets us our current. And then you've got your PP&E, you've got your investments, all that good stuff. That gets us to the total. And so you've got about $2.4 billion of assets. And then in terms of liabilities, how did they pay for those assets? Well, they paid for it with current liabilities, so accounts payable, deferred revenue, all this good stuff. And then they also paid for it with equity. And so you can see they've got a bunch of like a little teensy bit of like common stock. This is like at par value. And then they've got a ton of other accumulated paid in capital. And so this is basically how much did investors invest in the business? And then how much did they lose? Okay, so let's break this down in simplest terms. The business has $2.5 billion of assets. They financed about 750 million of that with debt. And then they financed and then they lost about 1.7 billion. And so if you add up these two numbers, um, basically like the 1627 plus 737, let me just put an equal sign in front of that. That gets you approximately, like, it gets you pretty close to this total assets figure. And basically the plug between that is this additional paid in capital. And so what we're saying here is we invested 3.3 billion. So we invested 3.3 billion of equity. We invested $740 million of debt. We lost 1.6 billion. And then the total remaining is more or less what assets we have left today. So that's how the balance sheet works. What do we have? How do we pay for it? Okay, great. So any questions on the financial statements? Otherwise, let's get into the building right here. Feel free to raise your hand, come off mute, whatever. Otherwise, let's get going. Okay, great. So this is the income statement tab here. And what we're going to be doing is we're going to be filling this out together. And I'm going to share my entire desktop so I can pull open two tabs of this model and show you one of my favorite tricks. So the first thing that I'm going to do is we're going to pull in information into this income statement right here. And the way I'm going to do that is I'm going to hit Alt W N. That's our first keyboard shortcut, folks, and you're going to be seeing it a lot today. And so what we're going to do here is we're going to have two different tabs of the same model open side by side. And so you can see right here that I've got it on my left and on my right hand, and they're independent of each other. So I'm going to go over on my left, or on my right hand of my screen, I'm going to pull up the actual data. And then on the left hand of the screen, I've got my model. And so you can notice that I'm switching between tabs by doing Control Page Up and Control Page Down. On a Mac, the keyboard shortcut for that is Command Option left arrow and right arrow. And in order to get these two windows open again, it's Alt and then W to go to the View tab, and then N to build a new window. That's this one right up here at the top. So two separate things, Alt W N, View tab, new window. That's going to save you a ton of time on modeling. So please make sure you get that down. Now, while you're pulling both those open, and again, that's why it's so important to have the accelerator keys thing. If you don't have it on Mac, you can just go click on the View tab and click New. Okay, so on this section here, I'm actually going to reduce the width of this column. So I'm going to do Alt HOW to adjust the width, and I'm just going to make it 80 wide so we can actually see these numbers. And then what I'm going to do is I'm going to start copying the downloaded financials from the like actual financial model or 10K, and I'm going to start plugging them into the historicals of our model. And so the first thing I'm going to do is I'm going to start with the revenue. So I'm going to take the revenue here. I'm just going to copy it. I'm going to hit Alt Tab to go over to the other thing. On the Mac, I think it'll be Command tilde to switch between Excel viewers. And then what I'm going to do is I'm going to do Control Alt V to open the Paste Special menu. Okay. And then what I'm going to do is I'm going to hit L, like the letter L as in like Lima. And so I'm going to hit L, and what that does is that links the model to the actual income statement. Or it links the historical 10K to the income statement. And so what this looks like, again, I'm just going to do that one more time. I'm going to say, okay, so we go over here and we hit copy on the thing that we want to paste over. We hit Alt Tab to go over to the other one. And I hit Control Alt V to open the Paste Special menu, which we're going to use a ton of times. And on Mac, that's Command Option V to open the Paste Special menu. And then I'm going to hit the letter L to paste a link. And while you guys are catching up on that, Tejas, yeah, please. If you had a question. Your hand is raised, I believe, but I'll keep moving.
Hey Max, I am clueless right now. I did press Alt WN, but nothing happened and grid lines came.
So grid lines coming, that's Alt WVG is that one. I would literally just click on the View tab and I would click New Window if the keyboard shortcut isn't working for you for whatever reason. Okay?
Yeah, it's still the same. Anyways,
Oh
never
yeah,
mind.
so just use your mouse then for now, and click New Window if the keyboard shortcut isn't working. And whatever you can do, if you need to, you can just keep flipping back and forth between the tabs. this should be possible on all modern versions of Excel, but I'm sorry that's not working. It'll just be a little bit more inefficient for you. You can still do the same things we're doing. Okay, so next up, let's look at the gross profit. So same thing here. I'm just going to copy the gross profit over, and I'm going to paste it, Control-Alt-V. I'm going to link that bad boy, and we've got the gross profit linked. Now, the reason that I'm not linking the COGS is because we can calculate the COGS. And so what I'm going to do is I'm going to take the COGS equals the gross profit minus the revenue. And the reason I do it that way is because I like to have, I like to basically have, I like to have all the expenses as negative, and I like to have all of the incomes and like positive things as positive. Everyone does that differently, but that's the way that I personally like to do it. And so let's link that up, and then I'll start going back and we can fill out these like percentage of sales things later. So for now, I just want to fill out the main line items on the income statement here. And so next up, we've got the sales and marketing expense. And so I'm going to take the sales and marketing expense. I'm going to copy this over, and I'm going to copy paste special, paste the links. And then the R&D, same thing. I'm going to take that. I'm going to copy paste, paste the links. And so Control-Alt-V, paste the links. And then for G&A, I'm going to go over here. I'm going to take this G&A line item. I'm going to copy that. And I'm going to go over here, and I'm going to paste the links. And there's a bunch of ways to like get these numbers over here. But like the fastest way is to paste links like I was showing. Another way, just to give you a little bit more versatility, is like you could literally just hit equal sign and go over here and then say equals this, restructuring thing. And that would do the same thing as copying and pasting the links. I just think it's slightly slower. Okay, great. So we've got the restructuring. And then our total operating expenses, we don't need to link over. We just need to calculate it as the sum of these other ones. And so the total operating expenses is going to be the sales and marketing plus the R&D plus the G&A plus the restructuring. Now, some of you may say, okay, I'm just going to do equals sum. I'm going to use a sum function, and I'm going to just sum up all this stuff up here. Now, that would work for now. But later on, once we put in like a percentage here or something like that, a sum function would capture all of the percentages. And if you ever find out that your total is off by like just like 1 or 2, then that's probably because you included the percentages in your summing there. And that's a very, very common mistake that interns and analysts make. Okay, so we've got our operating expenses, and then we can calculate our operating income. So our operating income is going to be the gross profit minus the operating expenses. The other thing that I just realized here is I've been making these expenses positive. I actually want to make them negative. And so what I'm going to do is I'm just going to go up there. I'm going to insert a negative sign. I'm going to make these negative. The other way that I could do that here, just to make it even a little bit faster if I wanted to, is I could basically, I could use this fancy tool called the paste special tool. And then I could click multiply when copying a negative number. And that will also turn it negative. I don't expect you to follow along with that. Get it negative however you want, and we'll ultimately have our negative expenses right now. And so operating expenses going to be 820 and 930. So let's just go over here and double check that that's right. Looks like that's correct. We've got the 820, we've got the 939. And so as you go in the model, you always want to stop and check whenever you reach like a major summing function like this to make sure that the operating expenses matches up with what you've got over here in the actual income statement. Now, next up, you've got our operating income. And so our operating income is going to be the gross profit plus the operating expenses. And so what you can see is it's actually negative right now. Like we're losing money as a business, which is why this is why the retained earnings has like an accumulated loss in it. And so let's see what this looks like. So in 2024, we lost 378 million. In 2025, we lost 330 million. So the loss is declining. It's getting smaller, which is good. And let's just double check that that matches up here. So the loss from operations exactly went from 378 to 330. So the company's losing money. And then we need to figure out what the EBITDA is. So for the first time here, we're actually not going to link to the income statement. We're going to have to link to the cash flow statement. So where do we get the cash flow statement? Well, the cash flow statement is going to be the second tab over here, and that's where we're going to get the depreciation and amortization. And so the depreciation and amortization is going to be this 38 and 42 million here. We're going to copy this over, Control-Alt-V, and then link that. And so then the EBITDA is going to basically be the operating income plus the D&A. Okay, so I'll pause there just for a second and recap what we did so you can catch up if you're not following along perfectly. Totally fine if that's the case. And again, remember, if you're getting behind, watch along instead of following along. If this is too fast or too slow for you, build ahead. So what we did here is we linked up the revenue to the income statement over here. Then we linked up all of the costs, including the COGS, the S&M, the R&D, G&A, restructuring, and we summed it up to get our total operating expenses. We summed up our total operating income. And then we built out our D&A and our EBITDA. So that gets us basically a GAAP EBITDA. This is not going to be the same thing as the EBITDA that the management team talks about. And I'm not going to get into why right now, but for now, we'll take this as our EBITDA. So any questions on the top half of the income statement historicals right now? Yeah, JS, go for it. Or maybe you just had your hand raised from earlier, which is totally fine. Okay, great. So let's keep moving then. So the next thing here is the stuff below the line. And so we've got our EBITDA, and then we've got all this, the operating, so we've got the financing assumptions. So remember the top part is basically this is the operating stuff, and then below the line down here is the financing stuff. And one quick note, just as a reminder, the easiest way to turn something negative is literally just to go to the top of it and hit negative sign. So if all else fails, do that. And if not, then like you should be good to go. And DNA shouldn't be negative. No, and this is actually a good point that Josh is bringing up. So Josh is asking, why is the DNA positive here? And the reason that it's positive is because we're adding it back. Now, if you go and dig into the financials and look at what actually goes into the sales and marketing expense, they actually usually include some sort of DNA in there. And so in the COGS, there's going to be a little bit of DNA that's associated with the cost of goods sold. There's going to be a little bit of DNA that's associated with G&A. And so to get to EBITDA, we've got to add back the DNA that was subtracted out earlier in the income statement. That's a great question. And so then that gets us to our EBITDA, and we've got to go below the line to try and figure out how we get to net income. Okay, so next up, we've got net interest income and expense. And so this is going to be, what is this going to involve? Let's go look at the income statement down here and think about what this should be. And so what I'm going to do here is I'm going to look at lines that look like interest income and expense. And I'm just going to say these three things, I'm going to sum up and call that net interest income / expense. And so what I'm going to do over here is I'm going to do this equals the sum of net interest income / expense. So we've got interest income, expense, and other here. And I'm going to sum those up. And so basically we've got about $46 million of net interest income and expense. I'm going to copy over that formula. And so this formula again is lines 14 to 16 over here on the income statement. And once we take that into account, that's basically going to be net interest income. Now, can anyone tell me why is net interest income greater than net interest expense, if you had to guess? Feel free to come off mute. Why would a company have more interest income than expense? Yeah, Anastasia, I see that you came off mute.
Yeah, they have a large excess cash or they have investment that they earn the interest income on. It's higher
Exactly.
than the interest they pay on that.
Yes. Exactly. Nice job on that, Anastasia. And nice job. Ryan and Riley also got to the same right answer, which is basically this is a cash-rich business. Like, let's go flip over the balance sheet real quick and just look at this. So right now they've got few hundred million dollars of cash. And then with the short-term investments, that's like $700 million of cash. And then debt, do they have debt? Like, not really. There's no debt on here. There's not like actual debt here. And so that means that they're going to be generating a fair amount of income through their interest. Okay, so then next thing we need to link up here is the taxes. And so provision for income taxes, that's what this one is right here. And you can see that it's actually also positive. Now, why is this positive and why should we make it positive? Well, that's because ultimately this is, let's just like look at this for a second. So if we look at it, their loss before income taxes is 332 million. And then their net loss is 338. And so this should be a negative number. On our side of things, they're presenting it as a positive number because they're showing the expenses as positive numbers. For me, I'm going to teach you guys how to model making these negative numbers. And so please make the taxes negative because you're paying taxes. It's not like the government is paying taxes to you. You've always got to be very careful on the signs to make sure that everything matches up when you do it like this, but it should match up. And so let's just take a look, make sure that everything looks appropriate. And so the pre-tax income Let me just double check that. Oh, I did that wrong because this is going to be the operating income. So this is why we double check everything. Yep. Okay, so make the pre-tax income link up to the operating income, not the EBITDA, because that would add back the DNA. And so then we just double check this. So if we go over here on the income statement, they've got 332 as the pre-tax income. That's what we've got right here. And then in 2025, we've got 281. They've got 281. Okay, so that matches up. Good. Let's go figure out what the net income is. And so we take the pre-tax income, we add in the taxes, get to our net income, and then we just double check that that matches. Great, we've got the 338, we've got the 288.
Hey,
Now,
Max, sorry, Max, can you tell me how did we come at operating income?
yeah, and just going forward, please do raise hands so I can stop and call on people. So operating income is going to be gross profit plus operating expenses. Does that make sense? Okay, awesome. I'm gonna assume that that's good to go. Okay, great. So we're at net income, and then we've got CapEx and we've got capitalized software. So CapEx and capitalized software. Let's take a look at this. So first off, what are we doing here? Well, so we've got net income, but we usually want to get to what we call like cash EBITDA. And so cash EBITDA is a metric that we use as investors and as bankers and things like that to basically understand like what's the approximate cash, because it takes a whole lot of work to build out an entire cash flow statement. And so a lot of times what we do is we just build out a teensy bit of cash flow statement on the income statement directly. Okay, so next thing we need to figure out here is the capital expenditures. So I'm just going to go over to the cash flow statement and I'm going to link up purchases of property and equipment. That's basically our PP&E, our CapEx, our capital expenditures. So I'm going to link that over. It's going to be pretty small. And then I'm going to link over capital software. And so for those of you who are interested in building or working in technology, capitalized software, this is basically software that you invest in for the long run. And so it's in the same way that like a physical goods company will purchase a factory, a software company will invest in software over the long run. And so this is part of CapEx, and you can see that it's in the cash flow from investing activities. So just go ahead and link up those two things from the cash flow investing activities, the CapEx and the capitalized software, to make sure that our GAAP EBITDA or GAAP cash EBITDA is the sum of these things. Now, for those of you who are a little bit more advanced, pay attention to this. And for those of you who are just following along a little bit more loosely, you don't need to worry about what I'm going to say next. But the other distinction I want you all to know is that this is not like the actual cash EBITDA. In order to actually make sure that this is the EBITDA that a management team or an investment banker or a private equity firm would actually look at, we would have to go into the 8K and do a bunch of non-GAAP to or GAAP to non-GAAP adjustments. And so nobody like GAAP EBITDA doesn't exist. That's a fake term that I'm making up to keep this model simple. But for those of you who are a little bit more advanced, pay attention to that because you're going to have to do non-GAAP adjustments to actually do this the right way. Today, we're keeping it simple though, and this gets a lot more complex. Okay, so let's recap what we just did. So we got EBITDA. We added in the net interest income because they've got a cash balance. That gets us to pre-tax income. We subtract out taxes. That gets us to net income. We subtract out CapEx and capitalized software, and that gets us to our GAAP cash EBITDA. So this is what's going on historically. And the next thing I'm going to do really quick here is I'm just going to start filling out some of these percentages. And for this part, I'm just going to move really fast because these aren't quite as important to the mechanics of the business, but they're important to understand. So for the growth rate, we can't calculate that in 2024 because we don't have 2023 revenue. So I'm just going to calculate that in 2025. And so it's this year divided by the previous year. Then for all of these percentage of sales formulas, I'm just going to take the thing above it, divide by the sales line. I'm going to hit F4 twice to lock the row, not the column. And so if you hit F4, it puts a dollar sign in front of the column and the row. If you hit F4 again, it just puts the dollar sign in front of the row number. And so that way you can lock the row, but not the column. And so I'm going to take the row, I'm going to copy that over. And you notice that I'm pasting formulas every time because I don't want to mess up the border on the right-hand side. And then all I'm going to do is I'm just going to copy this down. Our gross margin is just gross profit divided by sales. Our S&M margin is just sales and marketing as a percentage of sales. R&D is a percentage of sales. G&A is a percentage of sales. Restructuring is a percentage of sales. Operating expenses is a percentage of sales. Operating income is a percentage of sales. D&A is a percentage of sales. And so even though these are a lot of percentages, it moves really fast because once you write the formula once, you can literally just copy it down anywhere where I say percentage of sales. Taxes, this is going to be slightly different. So I'll come back to that in just a second. So we'll do percentage of sales there, percentage of sales there, percentage of sales there, and percentage of sales there. Okay, Great. So tax rate is going to be slightly different because tax rate is just basically calculated as the taxes divided by the pre-tax income. And so here you can see we've got a 1.8% tax rate. It doesn't really make sense because we lost money, and so the tax rate's a little bit wonky, but I'll calculate it just for the sake of completeness. Okay, so we just filled in all of the percentages here, and hopefully that makes sense. So if you've got the percentages, let's go with that. Now, next up, let's go and start thinking about our projections. But before I move on to the projections, any questions on the historical income statement we just built together? Okay, let's come down here and start thinking about how to project this. So the first thing that we're going to do is notice that I built out an assumptions section down here where we can fill in our assumptions in yellow here and then use that to fill out the actual numbers up top. You see how we've got historicals and projections. The other thing I want you just to notice here is that this is for the fiscal year ended January 31st. And so again, this is 2025A, which means January 31st, 2025. And so that's almost a year old now, or it's over a year old now. And then we've also got this calendar year thing over here. We'll get to that if we have time. That's not a big deal. Don't worry too much about that right now. So fiscal year, what we're going to do is we're going to start thinking about how to project this going forward. So the first thing is we'll want to fill in what the historicals are down here so that we can effectively analyze what the projection should be. So I'm going to link this up. I'm just going to say revenue growth equals this one right here. And I'm going to say that the gross margin, I'm just going to link that up. I'm going to say equals the gross profit margin. Sales and marketing equals the sales and marketing margin down up here. The G&A equal or R&D, I guess, comes next. And so make sure that you're paying attention. Okay, R&D. And then we've got G&A. And then we've got this restructuring thing, whatever that is. We can talk about that in a minute. And then we've got our D&A. And then we've got our net interest income as a percentage of sales, which is kind of a weird way to forecast it, but I'll explain why we did that. Our tax rate, and then our CapEx, and then our percentage capitalized software. Okay, so what we just did here is I just went and I linked up each of these things up top, and then I'm going to copy over the formula. And so take a minute and do that with me. And I'm just going to talk about why I did this. So basically what we did here is we calculated all of these margins to assist us in the forecasting. Because as we go forward, we can't forecast stuff like on just raw numbers. Like I'm not just going to say like CapEx is going to be like 1.9 million this year and that's going to be like 2 million this year or something like that, or 2 billion. What we have to do is we have to figure out these drivers down here. These are our assumptions drivers. We forecast those on a percentage basis, and then we use that to create the model as a whole. And so the most important driver that we need to forecast is the revenue growth. Now here, I'm going to do it very, very simply. And what I'm going to do basically is I'm just going to say, let's play around with this and like see what happens if we just say that the growth rate decreases by like, it goes down by, call it, maybe we'll say like, I'm going to play around with this, maybe like goes down by 8% a year. And so let's just try that. I'm just going to say, I'm just trying to solve for around 30%, maybe a little bit under it. I'm just going to multiply this by like 92% or something like that. Looks like I may have messed up the sales and marketing and R&D. Thank you. Okay, yeah, R&D is 35 and sales and marketing, I linked that up wrong. Thank you for catching that. Okay, so then on this one, let's just say that let's just say that we multiply this by 90%. And I like to do these sort of multiplication functions because it creates a nice trend line where it decreases at like a decreasing rate. And so you can see here that if we just multiply the prior year's growth rate by 90%, then the growth rate declines from 29 to 26 to 23 to 21, 20, 19, 17, 15. And the reason that I do it like this is because typically a company's growth curve goes something like this. It goes down over time. It stabilizes over time. If you've got a business that's growing 30% a year and it grows 30% a year forever, it's going to be the largest company in the planet in like a couple decades. And so you want to make sure that it declines at a slow and steady rate, the growth rate. Okay, so try that. And again, the way I did that is just like by multiplying it by 90%. And I'm actually not so worried if you get the exact same numbers as me. Like if someone here says, no, actually I want to make this like 25%, that's totally fine. But I care that you get the mechanics and you understand why you're doing what you're doing. Okay, so the revenue Let's do that. Now, for the gross margin here, I actually think that the gross margin could increase because look at this. It went from 71% to 74%. That's a pretty big increase in 1 year. And so what I'm going to say here is let's try increasing this by 0.5% a year. And so let's say that we go to 75% and then we go up a little bit from there. We go to 75, 76, 76, 77, 77, 78, and we'll just increase it ever so slightly every year. Okay. Now, how should we think about forecasting the sales and marketing and R&D? So the sales and marketing expense here, this has been really freaking high. It's like 60% of sales. That's an enormous amount of sales and marketing budget. And so how do we think about what this goes like? Well, it came down by maybe 4 or 5% this last year. And so let's see what happens if it comes down by 4 or 5% again this next year. And so let's say that we just take this and we subtract out, let's call it 4%. Or well, we'll add 4%. And so it's going to go from negative 59% to negative 55%. And so that's just going to show like, hey, we're going to get a little bit more responsible with our spending every year until it stops being like an enormous, enormous piece of sales. So let's just try that. You can do 4 or 5%, and that's going to be the sales and marketing is going to get slightly more efficient. Now, what about the R&D? Well, the R&D is increasing too, or it's improving as well. So like we went from 35% of sales in 2024 to 32% in 2025. And so I'm just going to take this, I'm just going to add maybe another 3% per year. And so it's just going to slowly come down as a percentage of sales. And what we're going to see is profitability is just going to continue to increase a little bit. Okay. And then what about G&A? Well, same thing here. This one went down by a ton. Now, if we decrease it by like 9% or 10% a year, that's going to go down to like 0 pretty quickly. And so what I'm going to do here is I'm just going to take this, I'm going to add 5% for a couple of years. And then I'm going to hold it flat. And so again, I don't care actually if your numbers exactly match mine. Like it doesn't really matter. I just want you to understand the mechanics and make sure that they kind of work. And I'm just going very rough here. Like there's a lot more detail that we could go into in terms of how we forecast the sales and marketing and the R&D and the G&A. But let me just recap that real quick. So with the R&D, basically with the sales and marketing, we decreased the percentage by 4% per year. So we're going from 60% of sales down to like 30% of sales over the projection period. Then for our R&D, we went from 30% of sales and then we added 3% a year down to 12%. And then for our G&A, we went from 23% of sales down to 7.5%, which is honestly pretty aggressive. Like that's probably not really very realistic, but we'll just keep it for the sake of the model by saying we're going to improve by 5% per year. So if they're getting very disciplined on their costs are staying the same and the revenue is growing a lot, then the G&A might look like something like this. Okay. So while you all are catching up on that, let's talk about restructuring. Like what is restructuring? Well, the restructuring is basically whenever there's like a major change in the course of the business, like there's some sort of like bankruptcy or there's some sort of major problem, the restructuring is basically going to be a one-time charge that impairs the profitability of the business. And so let's say that SentinelOne went through a bankruptcy proceeding. Well, they'd have to like pay a bunch of lawyers, they'd have to pay a bunch of bankers, they'd have a bunch of write-offs, a bunch of charges and things like that. And so whenever they restructure stuff, that's going to be a one-time hit. Now, it's one time, and so even though it's there historically on the income statement, I'm going to assume that this is going to be 0% going forward. And the only reason I'm showing it here is because you all are adults and you need to learn how to financially model and you need to learn how to deal with complex financial information like this. And on your income statement, you're going to see random things like restructuring expense. And your key rule here, and this is something that everyone who builds financial models should know, is whenever you don't know how to forecast something and it's pretty small, probably just assume that it's about 0 or hold it flat. Those are the two golden rules. Hold it flat or assume it's 0 if it's super small. And so in this case, the restructuring expense, we're just going to make 0 as a simplifying assumption. Okay. Next up, the D&A. So how do we think about D&A here? Well, D&A has been like pretty stable. And so let's just call it 5%. And you can see that like, yeah, we could make a more defined assumption there, but that's going to be approximately correct on D&A. What about the net interest income as a percentage of sales? Well, this one, again, probably shouldn't be forecasted as a percentage of sales. It should usually be forecasted as a percentage of the cash balance. But since we don't have that cash balance forecasted right now, I'm just going to assume that this is going to be about 3.5% of sales. That's going to be pretty high for a business that doesn't have as much cash as SentinelOne does, but SentinelOne has a ton of cash and equivalents, and therefore it's going to continue earning interest in the foreseeable future. Okay, what about the tax rate? Well, the tax rate realistically is not going to be 2.5%. What we're going to say is we're going to say the tax rate is 20, let's call it 25%, because that's like kind of like a mix of state and local taxes and things like that and federal taxes. We'll call it 25% tax rate. And so the 25% tax rate will be only apply if they have an earnings. And so we'll come back to that. But if they're losing money, we won't apply the tax rate. If they're earning money, we will apply the tax rate. Okay, next up, what about CapEx? On this one, it's very small, so I'm just going to hold it flat. Remember our two rules, hold it flat or make it zero. And so in this case, I'm going to hold it flat at the historical rate of 0.2% per year. And then on the capitalized software, I'm just going to actually make it the average of these 2 years. And so let's go through what I just did, and I'm just going to hold that flat. And so I'm just demonstrating a few of the different ways that you can forecast things. And so let me just blitz through these one more time. So the revenue, we decreased by 90% per year, the growth rate. And so it went from 30% to 15%. The gross margin, we increased by half a percentage a year. The sales and marketing, we added 4%, and so it went down from 60% down to 30. The R&D, we went down by 3% per year. The G&A, we went down by 5% per year, and then we held it flat after 2028. And then restructuring, we said was going to be zero. D&A, we held it flat percent, 5%. Net interest income, we held flat at 3.5%. Taxes, we said was a flat 25%, Ryan. And then CapEx and capitalized software. CapEx, we held it flat at 2.2%. And then capitalized software is just going to be the average of these prior ones. And so we took the average here. This is another common mechanism. So the ways that you forecast stuff, it can either hold flat, it can be zero, or you can do average. And so I'm just going to hit Control tilde so you can see my formulas while I answer Ryan's other question and any other questions you have. So you can see how I forecasted this. The way that I got into this view was hitting Control tilde so you can see the formulas. But first off, I'm going to answer Ryan's question while you guys are looking at this. So Ryan, are these cells supposed to be blue text? For forecasts like this, I usually make them blue. Some people who are purists might say, okay, well, you're not going to make it blue unless it's a hard code. And so in that case, it would just be like the DNA or the other things where I have like an actual number in here. But you'll notice that for all of these, except for CapEx and capitalized software, there is a hard code in here. And so like, even though this one is the revenue times 90%, the hard code is the 90%, therefore it's blue. And so general rule is whenever there's a hard code or like some big assumption you're making for a forecast period, I usually make it blue, Ryan. Does that make sense? And I also saw one or two other hands. Did those questions get raised? Awesome, Ryan.
I have a I have a question regarding the revenue. Like you have mentioned that the revenue goes down as low as 15%. Like what are the trends based on which the revenue is going so down?
The question is like, why is it going down?
Yeah, like you have mentioned that it goes down to 15%. Like,
Mhm. Yeah, so let's talk about that because I'm making a massive simplifying assumption here. And so on the job, you're not just going to say times 90%. The way you're going to do it as a banker is you're going to ask the management team, what's your revenue going to do? And you're probably just going to copy it if you're a sell side banker. If you're a buy side banker, though, or if you're a private equity investor where you actually have to think about it, you're going to have to forecast the revenue on a much more granular basis. And so the way that I would do this, Raul, is I would break it down by business line. So I would say, okay, how many like what are the products that you sell? Sentinel ones. They probably have like a security product. They probably have some services and things like that. And then I'd forecast out each of those business lines individually based off of the trends and based off of management projections, based off of earnings reports, based off of anything that you can find online. And I would try to figure out, okay, approximately what is the revenue going to do on an individual basis, and then I'll sum it up together. Now, for a SaaS company specifically, you're going to build a SaaS waterfall, is what it's called. I'm not going to get into that today, but it basically involves taking the retention rates of your existing customers, your projections on new customers, and that gets you to your beginning revenue and your ending revenue. I'll probably do a training on that at some point. So if you're curious, stay tuned. I'll post it on the website, post it in the Slack channels and things like that. But for now, we're just making a dramatically simplified assumption that it's going to decrease at a steady rate. And the reason that that's a safe assumption usually to make is that's what companies' growth rates usually look like. I don't care how successful a company you are, you can't grow at 30 or 50% per year forever. And so that growth rate's going to come down over time.
got it.
Take an example on this, Raul. So this year, Anthropic's revenue went from like Claude, Anthropic, they went from like about $9 billion of revenue in like December to $30 billion like a month ago or a couple weeks ago. And so that was basically like 100% growth rate like every month or something like that. Now, obviously, you can't double every month, or you can't like grow by like 80% or whatever the actual rate is every single month, because otherwise, pretty soon, your company would be larger than the US economy and larger than the global economy. It would be like the entire economy would be one company. And so necessarily it has to come down because that's how like percentages and growth compounding works. And so then the question is, how fast does it go down? And usually I would say that like a steady state growth rate for a business is somewhere in like the high single digits and stuff. And so if we forecasted this out a couple more years, I would go from like 30% to 15% to like 10% to maybe like 7 or 8%. So does that kind of answer your question, Roel?
Yeah, definitely. Thank you.
Awesome. Okay. Any other questions on how we forecasted these pieces? Hopefully, keeping the formula open here made it so you're able to at least catch up to this point, or understand what's going on if you're just watching along, which is totally fine too. Yeah, Rashmi.
Hey Max, in what cases you consider average? Because you said sometimes you have to take it flat, sometimes you have to put it 0
Mhm.
or average. So what
Yeah,
are some examples in which we'll consider average?
yeah. Let's talk about this. And so I'm actually just going to create a little bit of a table down here. So the ways to forecast things look like this. Okay, so flat is the simplest way. And it's basically when something has stayed steady. And so in this case, this one right here is like, well, let's see if there's a better example. None of all of these are changing so much we didn't really hold anything flat for this business. But let's say that we had a business that like the growth rate was 7% this year, and it was like 7.5% this year, and then it was like 8% this year, and then it was 7.5% this year, and then it was 7% this year, or something like that. Like for that one, we could probably pretty safely just hold it flat at 7% forever, you know? And that would be like a pretty simple thing to do when it's like, kind of just chugging along at a flat rate. The second thing that we can do is hold it at 0. And so this is when it's very small and no clear drivers. And so, for example, for restructuring expense, we put that one at 0, but first off, because it's pretty small as a percentage of sales, and then there's no clear driver. It's not like, oh, hey, when sales go up by 50%, we're going to have more restructuring, or when DNA increases, we have restructuring. So there's no like clear way to anticipate when the restructuring is going to happen. It's just like random events. And so if you don't have a clear sense of how to project it, you typically don't want to project it, because that would be like false confidence to say, well, I think we're going to have restructuring in 2027 and not 2028 or something like that. The third way to project things is I would call that a asymptotic convergence. And so that's a very fancy word for describing what we just did up here. And so I don't know if any of you guys remember your math classes, but like an asymptote is the concept of like declining towards something, but never quite touching. And so with an asymptotic convergence or something like that, we'd say that the revenue growth is going to go down until it converges with like a steady state. Or if it's really low, it will go up until it converges with a steady state. And so fundamentally, the idea is just like using a percentage basis to get closer and closer and closer to actual end state. And so that describes the revenue growth. And so I'm going to say most common with revenue. And then to converge with a long-term target. Okay, and then I'm going to just delete this. I'm going to hit shift space and then hit delete. And then the other thing is average. And so the average is what you're asking about. And so the average we use when things like kind of bounce around a little bit and it's not clear whether it should be closer to 2024 or 2025 or 2023. And so you just take the average of the last few years to say probably going to be somewhere in this range. When things have bounced around a bit and you don't know whether it's more similar to recent years or historical years. And so in this case, since it went from like 2.2 to 3.1, I don't really have a clear sense of like whether it's going to be closer to 2025 or 2024. I'm just going to take the average and hold it flat. So these are the 4 main ways to forecast stuff. And the reason that they're like so simple is like you want your model to be simple. I used to think that modeling was about creating the fanciest, most complex, most bells and whistles possible in a model. what I've learned, the more sophisticated I've gotten in my financial modeling and as an investor and finance professional and things like that, is that the simpler you can make the assumptions, the more you can focus on the quality of the assumptions instead of the complexity of the assumptions. And so I would rather you have, a very, very simple flatline assumption that you think about for half an hour instead of, some very complex formula where we increase it by 20% this year and then we add in a depreciation schedule and a complex CapEx schedule, and then it's like wrong. And so keep it simple, keep it thoughtful. In this case, we're not being particularly thoughtful. We are being particularly sensitive or simple. And if we do more advanced modeling courses down the line, we can talk about how to be even more thoughtful about some of these assumptions. So thank you for bringing that up. Okay, so hopefully everyone's caught up on the assumptions and the historical side of things. Now we're actually going to begin with the core projections piece of the modeling. And this is actually going to go faster than you'd expect because we did the hard work of building the historicals and building the presumptions drivers. And so the way that a financial model works is it's kind of like a U-shaped action where we work our way down the left side, like at the bottom to get to the bottom of the U. We forecast over the assumptions down here, and then we build back up to get all this stuff over here. And so it's kind of like a U-shaped model where we do historicals, do projections, do the actual numbers projected. So let's go and fill this out. So if we know what the historical revenue is, and we know what the growth rate is going to be, we know what the forecasted revenue is going to be. And so what I'm going to do is I'm just going to take the historical revenue, I'm going to add 1 plus the growth rate here, and we'll get our forecasted revenue. Okay, so let's take that, copy that over. I just hit Control R to copy that over to the right. Okay, so we've got that. You can see it grew from 1 billion to 3 billion. And then if we want to, we can copy over this growth formula. And I'm going to copy and paste the formulas, not the values, not the templates, or not the formats. Otherwise, it's going to mess up our formatting. And so you can see this basically is just going to literally mirror what we have down here. And so I didn't really even need to calculate that down up here because it's just the same thing that we have down here. But I'll do it for the sake of completeness. Okay. Next up, the COGS formula, that's just going to stay the same. Remember, we're calculating this as a difference between the gross profit and the revenue. We could also just link it back to the historical financials, but where possible, I like to link as few numbers as possible so we can use that as a check and so that we can keep our model as simple and as flexible as possible. Like if you change your historicals, you don't have to link up 3 numbers if you can just link up 2. Okay, so we're going to take that. I'm just going to copy this formula here. And so I'm going to take that and I'm going to copy Control-Alt-V, F to get formulas, and then Enter to copy the formula. So F to get formulas. And so right now you can see it's calculating as 100% of sales. As soon as we figure out the gross profit, it's not going to be. Okay, so next up, gross profit. Let's go take the gross profit, and I'm just going to say the gross margin here is 75%. And so I'm going to link the gross margin down there to the 75%. I'm going to copy that over using Control-R, and then I'm going to take the gross profit at a dollar basis by taking the margin and multiplying it by the revenue. And so we've got our gross profit on a dollar basis going like this. So hopefully that makes sense. We've got the gross margin, we've got the revenue, we multiply those together, we get to our gross profit. Okay, that gets us our gross profit. Any questions on that top piece? Y'all with me so far? Love it. Okay, let's keep working our way down the income statement. Raise your hand, drop questions in the chat. I'll stop once we get to the bottom of the income statement. So sales and marketing expense here, basically this one here, all I'm going to do for each of these is I'm going to link up what it is at the percentage basis. So I'm going to link the sales and marketing expense. I'm going to go down to the R&D. I'm going to link up the R&D expense. So I'm going to go hit R&D. And then I'm going to go link up the G&A expense. I'm just going to go hit G&A. Let me get that. And then I'm going to link up the restructuring expense. I'm going to link that right there. I'm going to link up the, well, I guess, and then let's stop there because this is our formula. And so you'll notice that I linked all of these up. Instead of linking each one individually and then copying it right, I'm going to save myself 5 seconds by taking all of it at once and then copying it right. And so that's just going to save us a teensy bit of time. Something that we could do that would be even faster would be if I actually built out the dollar formulas and then copied everything over once. Now that doesn't matter right now where we've got plenty of time, but if you're in a modeling test and you're building a financial model under pressure, you want to find little ways like this to save a few seconds so every time you can get a little faster. So let's go and do that actually best practice. We're going to take the driver, the percentage of sales, and multiply it by the revenue. And so the way that this works is we're basically saying, okay, we have the percentage of sales forecasted. It's going to be 55% of sales. And we know that the sales is $1 billion. And so if we just multiply those together, then we know what the sales and marketing expense is going to be. So I'm going to take that and I'm going to make sure that I locked it just the row, not the column. And then I'm going to take that and I'm going to go down here and I'm just going to actually copy these and make sure that they look approximately correct. So this should be 0. This should be a little bit bigger than the last year. This should be, a little bit, okay, great. This looks kind of right. And so what I'm going to do then is now I'm going to take all this and I'm going to copy it over. And we could even wait until we finish the entire income statement to copy it over, but we'll just do this for now. Okay. So that gets us sales and marketing, R&D, G&A, and restructuring. Let's get our operating expenses and operating income. And this stuff, we can actually just copy the formulas because remember, these aren't using our assumptions. This is just outputs of what's above. And so pretty quickly, again, this took us like 5 minutes. We have most of the income statement forecasted because we already did the hard work of the assumptions down here. So let's link up the remainder. What's our D&A going to look like? What's all the rest is going to look like? So D&A, I'm going to link this up here to the 5%. And then let's calculate what the D&A is going to be. I'm just going to, again, use this formula that we had up here, multiplying it by the percentage of sales. And then we'll copy this over. And then our EBITDA, this is a formula, so I'm just going to copy that formula over. And then our net interest income, okay, great. So let's copy this driver. So the interest income is a percentage of sales. Again, probably doesn't make sense to drive it as a percentage of sales, but we're just simplifying stuff right now. Going to copy that over, copy this formula over. And so then pretty soon we've got our net interest income. Then we'll take our pre-tax income formula. We'll copy that formula over as well. Control-Alt-V-F to get to the formulas, and then we'll do our taxes. Okay, so I'm going to pause for a second on the taxes because this is probably the most complex part of the forecast that we've done so far. So let's say that I just take the tax rate and I say, okay, our taxes are going to be 25% of our, equals 25% of our pre-tax income. Well, great, we just paid $64 million of taxes. Does that actually make sense? Well, no. We lost money. We shouldn't really be paying taxes until we're earning money. And so in year 1 and year 2 of our forecast period where we're losing money, you can see that they've been paying a very nominal amount of taxes. These are just basic minimal fees in random states or cities or federal jurisdictions. Don't ask me what goes into this because tax law and tax accounting is extremely complicated. And so you probably want a specific tax advisor to explain to you why they're paying taxes even though they're losing money. But the reality is, historically, you're not going to be paying taxes until you turn a profit. And even then, you'll probably have net operating losses to offset future profit. We're not going to get into that right now. So if you don't know what net operating loss is, forget I said it. But for those of you who do know that you would actually be paying attention to that in a company like this that's losing money. Okay, so taxes. What are we actually going to do here? Well, what we're going to say is we're going to do a little if function. We're going to say if this is greater than 0, then we're going to take the tax rate. We're going to do the negative tax rate because we want this to show up as a negative number, multiplied by the pre-tax income. Otherwise, we're just going to make this 0. And so what that's going to mean is we don't have any taxes until year 3. And let's just check that our formula works. So in year 3, we're saying we're going to pay 25% of the 15 million in income. So yeah, 3 or 4 million in taxes. And then as you can see, over time, as we become more profitable, we start paying a lot of taxes. Okay, so tax formula, again, just to recap it here, we're basically saying we're not going to pay taxes until we generate a profit, and we don't generate a profit until year 3. And so we say if the pre-tax income is greater than 0, then we'll take the tax rate times the pre-tax income. Otherwise, we'll just make it 0. Okay, hopefully that makes sense. Let's go to net income, which is going to be pre-tax income plus taxes. And then we can take this as a percentage of sales to figure out what that's going to look like. So let's copy that over, see what that looks like. You can see that ultimately our pre-tax or net income turns from negative and we're losing money to we start to slowly gain money and become more profitable. And so this is what businesses look like usually. The income growth decreases, but the income increases, or sorry, the revenue growth decreases and then profitability increases. And so there's this kind of X curve where the income or the revenue is going down because it's like you have to have that asymptotic convergence, like I was mentioning. The revenue growth decreases. And then over time, usually the profitability increases as you become more financially responsible as a business, as your costs scale, as you get operating leverage. And so you can see the business goes from losing 50% of its revenue per year to gaining about 23% per year. And that's going to happen in a few years. And that's just Max's guess. Like, we'd want to go and talk to management. We'd want to go and understand what that actually looks like. But this is not a terrible assumption. Okay. Last up, we've just got 3 more things to project here. So we'll take our CapEx. You know the drill at this point. We link it up to our CapEx assumption down here. And then we take our capitalized software assumption. We link it up to our capitalized software assumption. And then we take both of those and we multiply it by the sales thing. So I'm just going to copy this formula down again. And we'll see how that goes. And then we'll just copy this formula over, and then we'll copy all 3 of those things over at once. And we'll see how our GAAP cash EBITDA, which again is kind of a made up metric for the purposes of this exercise, what this actually looks like. Okay, so let's recap, just catch you up on what we did. So revenue, we took the growth rate, one plus the growth rate. COGS, we did this as a formula where it's the difference between gross profit and sales. We took COGS as a percentage of sales. We took gross margin as a percentage of sales, or we linked this one up and we calculated the gross profit margin. And then for all of these operating expenses, what we did is we took the percentage of sales from down here, and then we took the dollar value by taking that and multiplying it by the actual sales. And then going down here, we go into our operating expenses, which is the sum of all the stuff up here. And then we took our operating income, which is the gross profit margin plus or minus the operating expenses, add back the D&A, get to our EBITDA. And then on the net interest income, we did this as a percentage of sales. So we took the percentage down there, took this, multiplied it by the sales, calculated our pre-tax income. The taxes one was the most complicated one, where we basically said, if it's not making a profit, don't pay taxes. If it is, use the tax rate. And then we calculated our net income. We subtracted out the CapEx, capitalized software, and GAAP cash EBITDA. Now, the other thing I'm just noticing here is I'm calculating this GAAP cash EBITDA off of net income. That's totally wrong. So please with me, everyone go ahead and correct this. It should be the EBITDA minus the CapEx minus the capitalized software. That's what you should actually be doing. It should not be based off of net income. That was my bad. So let's copy that over together. Okay. So with that, any questions on projecting the income statement here? Any questions on how we get to this? What does yours look like? Any difficulties? Yeah, Josh.
Sorry, quick question. I think for COGS, yeah, you mentioned that's going to be percentage of sales. I think my number is just a little messed up. For your formula, you basically just took the actual value divided by revenue, or I think I might.
Yeah. So for the COGS here, this one is basically we've got the actual value divided by revenue, because that's what we did historically. So I just copied these formulas over. And the COGS percent, or the COGS here, is basically the gross profit minus the revenue. Now, if you accidentally flip this around, like if you do this minus this, then it's going to show up as a positive number, and it'll still be like correct. It's just shown in like maybe a slightly suboptimal way. And so make sure it's a negative number, and then this part here you can just divide it by the revenue. Does that match up with what you got now?
I think maybe because I since they were hard coded in the historicals for COGS. Did you just simply put a formula for the row 20?
Yes, this shouldn't be hard coded. This should be a difference between the gross profit and the revenue, right?
Gotcha. I think that's why. All right, thank you.
Yeah.
That makes sense. All right.
Absolutely. Yeah, Anastasia.
Yeah, thank you. I just want to ask for assumptions. Is it a common practice to put them underneath, or do you sometimes put them on a separate tab and then like link in between?
Great question. So both are common, and it depends on how complicated your model is. And so if we went through and we had like 10 different revenue drivers, and we had like 5 different drivers of sales and marketing expense, which a lot of these models do have, you would typically want not just a separate tab for the assumptions, but probably even a separate tab for each of the assumption groups. And so you could have an entire tab, and honestly, most models do, an entire tab dedicated to revenue growth projections. In fact, there have been some I've built entire models with like 30 or 40 tabs that are only used to forecast revenue. So we're just scratching the tip of the iceberg in terms of revenue projections. And so what that would look like is you'd have 5 different business units. And so you'd have a tab for each of the business units. And then you'd have an assumptions tab for each of those where you're saying, okay, the revenue growth rate's going to be like this. The retention is going to be like this. The average selling price is going to be like this. We're going to break it down by geography. We're going to break it down by size of customer. You might even have a customer by customer file that says, here's our top 100 customers and what we think we're going to generate in terms of revenue from each of them over time. And so that would be separate tabs. Now, for our purposes, since we're only using about a dozen different assumptions, it makes more sense to include them on the same tab so we don't have to go back and forth and link them between tabs. But if it got much more complicated than this, you could very well create an income statement assumptions tab and link it back.
Okay, got it. And then quick follow-up, but like if you want someone to review your model, obviously, like how do you put any notes on like your logic or the rationale for using certain assumptions? Like what I've noted, like there are some practices like adding a comment or added a review note or like just put in like on the side, like what's the way that you recommend of doing it? So person reviewing
Love
it
that.
can follow along. Yeah, thanks.
Love that question. Love that question. So there's a few ways to do it. Probably, and I'm actually going to create a separate little note for this. So ways to show your thinking, because realistically, the worst thing that's going to happen is you build a model and your associate looks at it and they're like, what the hell am I looking at? and they're just like, this, I don't know how to read this. This is trash. Like, bottom bucket bonus. And so the best things that you can do is you can have your, you want your associate or your VP or whoever's looking at your model to understand what's going on. And the first way to do that is just to like have a very clear model that uses the exact same assumptions they would. And so, for example, like if you think that your VP would make the exact same assumption on revenue right here, then you're not even going to have to explain the revenue. They're just going to be thinking the exact same thing. And so if you can read your associate's mind, you're good to go. You don't really have to write notes and you don't have to really write, like, explain it. Obviously, that's very difficult. And so although you'll get close to that, the more that you learn about judgment and the more that you like imitate their thinking, you do realistically have to show your thinking in other ways. And so the second thing is through a notes column. And so what that would look like is you'd have a little column over here where you'd say notes, and you'd say declining asymptotically to converge with long-term expected growth rate of 15%. And then on this one, you would say like improving the G&A percentage until 2028 and holding flat thereafter. And so it's just like kind of like writing a brief description to describe what you're doing. That's going to be really, really helpful. I would usually pair this notes column, pair this with a detailed email. And so when you're building the model, I usually, and here's what I did at Catalyst when I was an investment banker there, is I would have my Excel open on one screen and have my email open on the other screen. And as I went through each of the assumptions, I would create a note in the email for my associate where I would say, by the way, when I was building out this line item, here's what I was thinking, here's what I was thinking. And like I would send them a really long email. And so at the top of the email, I'd be like, hey, hey, Sam, here's my latest model for XYZ project. Just wanted to share some of my thinking below. If you can't follow along with the model, feel free to reference this. This will tell you everything you need to know. And then I'd give them 20 bullet points, clearly explaining exactly what I did on each of them. So if they had a question as they were reviewing my model, they'd read the email, see what I did, see if they liked it, see if they didn't like it, and then they could respond to the email with detailed comments. That's the second thing. The other thing that you can do is comments on cells, where, for example, let's say that this year we knew that there was going to be like a spike in G&A, and so I make this 12%. I'd say I would probably want to comment on that cell specifically because it's like a one-time thing, and I would say I'm going to say spiking in 2030 due to the conference expenses or something like that. And so you can put a Shift F2 is what you do to leave a note. Shift F2 is to leave a note, and then Alt HEM. I'm just going to delete the notes. That's what does like a comment. So comments are also good. Now be careful not to use the like other comments. If you do Control Alt M, I believe it leaves like this type of comment. This is not the type of comment that most bankers use. That might change eventually, but in the near term, you want to use the little red dot comments, the like Shift F2 comments. And so I'm just going to put that keyboard shortcut here, Shift F2. And by the way, if you're on a Mac and you don't have the function keys enabled, you're definitely going to want to enable the function keys. In fact, I'm going to make a note for myself to explain that in future training sessions. Function keys max. And then the last thing that you could do is record a Loom video of you walking through things. And so what this means is basically, since we're in 2026, the best way to convey your modeling thinking, honestly, would be to record a quick video using a tool like Loom and send it to your associate walking through exactly what you did, where, and why. Very detailed answer to a very good question. Does that make sense?
Yes, tons of sense. Okay, a quick follow-up on this. I know you said notes versus comments, right? Like the only thing that I have, like when you do the like that comment, that other thing, you're able to actually click and say review all comments. So that's how like I've done it, like let's say at Big Four, where we like leave the comments and we can actually see like how they address the comments, or like how does it work in banking where like they have a problem with you and they leave a comment on your Excel? Like, is it different?
Most of the time, they're going to leave comments over email. Like, obviously,
Okay,
it
got it.
changes
Okay.
year to year and bank to bank, and so every culture is different. But at Lazard and Catalyst, for me, they would just come back in email because they really wanted a clear paper trail over email about exactly what was going on, when, where, and
I
how.
see.
Because it's pretty easy to lose a comment in a massive 50-tel Excel or
Right.
50-tab Excel, whereas it's harder to like miss it if they like put it in an email.
Okay, perfect. Thanks.
Yeah.
Thanks a lot.
Absolutely. And then Joshua, let's take yours, and then we'll jump into the cash flow statement, everyone.
Cool. Thank you. So I pretty much had everything you had. I just left a note for something that I missed so I can raise my hand and come back to this. But so for pre-tax income, could you show me the historicals one more time about how we calculated that?
Yeah, so the pre-tax income for the historical years is basically saying what is the operating income plus the net interest expense. And so this is, again, just remember this operating income here, this is EBIT. This is the same thing as earnings before interest and tax. And the net interest income, or the pre-tax income, is EBT, like earnings before tax. And so if you go from EBIT to EBT, all you do is you subtract out the interest. And so in this case, the interest expense is interest income. Like it's actually a positive cash flow. Remember we discussed that. And so in this case, the interest, the pre-tax income is going to be higher than the operating income. That's uncommon, but it is the case in this business.
Gotcha. Okay. All right. Thank you.
Awesome. Okay, so let's jump over to the cash flow statement here. You guys have been cranking along. Take a second, stretch. We're 90 minutes into the modeling here, and we've got 90 minutes left to build 2 more financial statements and talk about valuation. So we got to move fast here. Stay locked in. Get some caffeine in you. Do some jumping jacks, do some push-ups, whatever you need to do. Take a glass of water, and then let's jump into the cash flow statement. So cash flow statement here. This is a very simplified cash flow statement. And what I want you to pay attention to here is the idea that we're only forecasting the things that we need to figure out what the actual changes in cash are. And so this is more like a cash flow assumptions driver tab than an actual cash flow statement. And then we're going to build out the full cash flow statement on the balance sheet tab here, which I know is a little bit confusing, but this is like the full 3 statements tab. And so this is a little bit of a misnomer. This is not like really the cash flow statement tab, but it's going to help us build out the assumptions that we need to actually have a cash flow statement. Okay, so first off, as with what we've been doing before, I'm going to start out by linking up the historicals. And so I'm going to start out by linking up the accounts receivable historically. We're going to take the accounts receivable, and I'm just going to link these over, and I'm going to move pretty quickly on these. And actually, I'm so sorry, this is going to come from the balance sheet tab, not the cash flow statement tab, because we want to get the raw value. So go over to the balance sheet tab on one half of your screen and go over to the cash flow statement on the other half of your screen. And so the first thing we're going to do is I'm going to take these accounts receivable. I'm going to link these bad boys right up over here. And that's going to be using the Control-Alt-V-L link thing. So we've got the accounts receivable. I'm going to take the other current assets. Now, the other current assets, there's a lot in there. And so what I'm going to do is I'm going to take, I'm just going to take this this C10 over here. So I'm going to link up the prepaid expenses and other current assets. And I'm just going to ignore the rest of it for now. Like this is what looks like working capital to me. And that's because this is the stuff that's like actually involved with the day-to-day operations of the business. And so I think that's going to be our working capital assets. Now on the current liabilities here, let's link this up together as well. And so the first thing we've got is accounts payable. And so you can see here, where is that? Accounts payable, oh, down here. Great. Okay, so we've got our accounts payable, and then we've got our accrued payroll and benefits. So we'll link up both of those lines. And then we're going to have both of those. And so I'm just going to link those back up over here. And then I'm going to link up the other current liabilities and then the deferred revenue. So let's link those up. And then I want to talk about deferred revenue for a second while y'all are getting caught up in like actually copying these over. And so the deferred revenue here, as you can see, is enormous. Like this is a huge chunk of the cash flow for the business. And so it's important to understand like what's actually going on here. And what this is this deferred revenue. I'm just gonna make sure I link this up correctly. Actually, I missed part of it. You see how this says deferred revenue current? That also means that there's a non-current piece of deferred revenue. And so I'll talk a little bit more about this, but for now, let's just fix that real quick and then I'll explain what this is. So deferred revenue basically has a current and a non-current portion. And what this is this is revenue that we've earned or we've collected the money for, but we haven't actually earned. And so the simplest way to explain this is through something like Netflix. Like I don't know how many of you have some sort of like streaming TV subscription or something like that. But if any of you have some sort of like Netflix subscription, my guess is that you pay them, call it like $100 at the beginning of the year. And then over the course of the year, you get to watch Netflix. Now Netflix on day one, they didn't earn any revenue. Like they didn't actually do anything. They didn't provide any goods or services to you. And so their revenue is zero, but they've got $100 of cash. And so what that does is that increases the deferred revenue on the balance sheet by $100. And so for you, what that means is that you've got to basically take that deferred revenue and consider that a liability, where you've got the cash, but you've got to pay for it over time by delivering goods and services. And so that's going to be a liability, but it's a liability that increases and generates cash. And so we really like deferred revenue as investors and as bankers and things like that, because the more deferred revenue you have, the more money you make in terms of cash. And so we really like to see a business like this where they've got hundreds of millions of deferred revenue and it's increasing, because that means that we're generating cash. Okay, now next up is the net working capital. So I'm just going to fill out some of this historical stuff and then we'll project. So remember, we're doing a U-shaped projection thing where we've got the historicals, we'll project it out in the future, and then we'll build up the forecast. So net working capital is going to be the current assets minus the current liabilities. This is the formula for net working capital. That's a common accounting question that comes up in interviews, is the current operating assets minus the current operating liabilities. And so you can see that that's going from 389 to 432. And so the increase or decrease in net working capital is just simply going to be equal to this minus this. And you can see that the net working capital is decreasing by about 45 million a year. Now, can anyone tell me, is this decrease in net working capital, is that going to be a good thing or a bad thing for our cash? Like, is that a source or a use of cash? Yeah, Josh.
A decrease in net working capital technically would be a source of cash.
Exactly. Explain to us why.
So when it decreases, it basically kind of means that like for example, if AR went down, then basically we've got collections of cash. Or if it's a result of liabilities going up, it means that we probably got some sort of funding or like some sort that we didn't have to use cash, or be paid on account or something like that.
Exactly. And Emil, good job on that. You've got the same intuition as well in the chat. And so this is a really important concept that I'm just going to break down for a second. And so let's say that we've got liabilities and we've got assets. And so if the liabilities increase, I'm just going to do a plus sign, then that is going to be, and I guess I'll just do this here. So if the liabilities increase, that's going to be a use of cash. If the liabilities decrease, that's going to be a source of cash. If the assets increase, that's going to be that's exactly backwards. So this is going to be a source and then a use. And so let me explain that a little bit more. So if our liabilities increase, this is debt increasing, this is deferred revenue increasing. That's going to be like customers paying us for stuff that we didn't deliver. That's going to be us taking out new debt. That's going to be cash in the bank. However, if we're paying off our debt, or we're like generating the actual revenue that we got paid for, like if we're Netflix and we're reducing our deferred revenue, or we're paying back our accounts payable or something like that, that's cash out the door. And so that's going to be use of cash. So liability increase, source; liability decrease, use. Now, next up, asset. So if asset increases, you're buying stuff. You're buying a factory. You're buying the corporate jet, as I keep joking about. And so that's going to be use of cash. If our assets decrease, you're selling stuff, or like your accounts receivable is going down, and so you're collecting on payments, or your inventory is going down, which means that like you sold stuff and you get to collect on that inventory. And so that's going to be a source of cash. And so then we've got to talk about the net working capital. And so if net working capital increases or net working capital decreases, is that a source of use of cash? And so net working capital, again, remember, this is current assets minus current liabilities, specifically operating liabilities. And so if the net assets increase relative to the net liabilities, that's basically just saying that this is going to be more important than this, and therefore it's going to be a use of cash. Whereas if the liabilities are dominating relative, or are increasing more relative to the assets, that's going to be a source of cash. And so just remember this: liabilities increases a source, assets increases a use, and net working capital is the same thing as like the assets. It's going to mirror the assets because it's basically the net current assets, net current operating assets. Okay, so in this case, just to tie that back, the net working capital decreased because of the deferred revenue primarily. Therefore, that's going to be a source of cash. Okay, a couple things. We've also got to link up. So we want to link up next up our revenue and our COGS. And the reason we want to do that is because we're going to forecast some of the stuff based off of that. And so I'm going to take our revenue over on the income statement tab. I'm going to link that up here. And I'm going to link up our COGS as well. Whoops. Let me just get that back. Okay, and then we're going to link up our COGS. So I'm going to take those. I'm going to link that up. And then we're going to start forecasting some of these like assumption drivers. So the ways that we're going to forecast this is accounts receivable days, accounts payable days, and then we're going to calculate a few other things as a percentage of sales. So we're going to do other assets as a percentage of sales, accrued payroll, current liabilities, and change in deferred revenue as a percentage of sales. So for these ones, let's talk through what I mean by accounts receivable days. And so accounts receivable days, basically what this is this is saying what percentage of a year, like how many days of a year of stuff outstanding do we need to go collect on? And so in this case, all we have to do is we have to take the accounts receivable and we divide it by revenue. And that gets us the percentage of the year that things are outstanding. And then we multiply it by the number of days to get the number of days. And so let's break this down a little bit because this is very unintuitive. So basically what this is saying is like, let's say that we are, that rocket ship company and we sell 600 rockets a year for $1 each. If we currently have 200 accounts receivables right now, $200 of accounts receivables, then that means that we've sold 200 rockets that we haven't been paid for yet. And so if we sold 200 rockets that we haven't been paid for and we have 600 rockets per year, then that means that roughly 1/3 of the year we've sold stuff that we haven't been paid for. And so in terms of days, that's 120-ish days. And so what we're saying is about 1/3 of the year of our sales we haven't received yet in cash. And so that's going to be what it is for 2024. And then let's see what it is for 2025. So copy that over, and I'm just going to copy over the formula, not to mess up that formatting. And so you can see it came down slightly. Okay, next up, other assets as a percentage of sales. So the rest of the stuff that's like we're calculating as a percentage of sales, super simple. You guys know how to do this. So I'm going to take the other assets, I'm just going to divide by the percentage of sales, and lock that for good practice. Copy over the formula. Next thing that I'm going to do is accounts payable days. This one's a little bit more complicated. It's similar to what I just described, but instead of using revenue as the driver, we use COGS as the driver. So let's talk about the intuition after I build the formula. So the first thing is going to be taking the accounts payable, dividing by the COGS, and then multiplying by the days. And then just to make this a positive number, since days being negative doesn't really make sense, I'm just going to make that a positive number. And so what this is saying And that's because our COGS is showing up as a negative number. What this is saying is that we've got this is saying basically that we've got 14 days worth of COGS outstanding that we haven't paid for. And so the way that we think about this is accounts payable. This is things like for our rocket company, for example, this would be like paying the person who builds our rocket engines or something. So our rocket engine supplier. And so that would be our payables, is like these rocket engines that we've got to go buy. And so if we haven't paid them, that's a payable. And ultimately, when we do pay them, that goes into the COGS on our income statement. And so the COGS on our income statement is all of the money that we're paying to our rocket engine supplier, because that's part of the cost of goods sold of delivering this rocket to our end customers. And so in this case, what we're saying is we actually have only about 14 days of like rocket engines that we haven't paid for. And so that's pretty small in terms of accounts payable days, but because it's associated with the COGS instead of the revenue, we forecast it as a percentage of COGS relative to versus revenue. Now, next up, what we're going to do is the accrued payroll, other current liabilities, and change in deferred revenue. These are all going to be done just as a percentage of sales. Now, if we wanted to be a little bit more precise about it, we'd probably do the deferred revenue one as a percentage of change in sales, for a reason I won't necessarily get into right now. But for now, what we're just going to do to make it super simple is we're just going to forecast all of this as a percentage of sales. Okay, so that means we've got our drivers historically. And now what I'm going to do is I'm going to start forecasting those out. But just to make sure you guys got them all, I'm just going to briefly show the formulas again, run through it. So the accounts receivable here, this is basically going to be the accounts receivable divided by the revenue times the days. Then this, and most of this is going to be as a percentage of sales. And then the accounts payable is going to be accounts payable divided by COGS times number of days. So stop me here. Any questions on these historical drivers? Because we're going to move pretty quickly to get the forecasts done from this point. Okay, great. So let's forecast these things out together then here. So the accounts receivable days, let's start by basically just saying, okay, it's probably going to decrease a little bit more, but maybe not that much more. So let's say that it comes to 100 here, and then maybe down to like 95, and let's just hold that flat. And so that's based on the fact that like it decreased quite a bit historically. It went from 125 to 105. And so I'm just, kind of converging it down to a baseline. Again, we could play around with this assumption. We could think about it, but that's what I'm going to do for now. And I'm also going to pop this screen open a little bit more because we don't need the right-hand side now. Now, next up, other assets is a percentage of sales. Basically for this one, I'm just going to hold it flat. Keep it super simple. Copy this over. And then okay, great. So now this is going to be held flat. And then accounts payable days on this one, I'm basically just going to hold this flat as well. And then, and so we'll hold that flat. And again, some people would make this black because it's like technically, holding it flat. It's not a formula. For me, I'm going to make it the blue color just because these are all assumptions. And I'm just going to do that again. I also like to keep colors in my quick access toolbars, unless you have like CapIQ or FactSet plugins or Macabacus plugins or something like that. It's usually easier to just keep that in the quick access toolbar up there. Okay, and then accrued payroll as a percentage of sales on this one, because I don't know if it's going to be more similar to 2012 or 2024, I'm just going to hold that flat at an average. And so I'm going to say that's the average, and I'm going to hold that flat. And then for the other current liabilities as a percentage of sales, I'm going to do the same thing here. And so I'm just going to copy this down. And we'll just hold it flat at that like 12%. Now, one common mistake that a lot of students make when they're building these models, just to be aware of, is they'll take this average formula and they'll just copy that over. And so look at that here. Basically what it does is it takes like a running average of the prior years, and it looks kind of funky. You got like 10.3, 10.5, 10.4, 10.5, 10.4, 10.5. Good luck explaining that to your associate. They're like, why did it go 10.4% and then 10.5% every year? And you're like, well, I don't really know. And that's because really, you probably made a mistake. I would just try and hold it flat at the average. Okay, and then next up, change in deferred revenue as a percentage of sales. This one's a big one. This one's really important. And so here, what I'm going to do is I'm going to do one of those asymptotic convergence things. So I'm going to basically say this is going to come down. I don't know how fast it's going to come down. And so let's do it first off at like, 95% or something like that. And so I'm just going to say each year is 95% as large as the prior one. And so we're generating a lot of deferred revenue, and that's going to be a massive boon for our cash flows. Okay, great. So let's take a look at that, and then let's plug this back in here. So I'm just going to, again, briefly show all the formulas for each of these, how we did it. So the accounts receivable, took it 195 and then held it flat. For the accounts, other assets as a percentage of sales, held it flat. Accounts payable days, held it flat. The accrued payroll and benefits as a percentage of sales basically took the average and then held it flat for both of those two. And then for the change in deferred revenue, I basically just continued it at about 95% of the prior. So let's take a look at that then. So the accounts receivable here then, what we're going to do now, this is probably one of the more complex formulas for the cash flow forecast, is we're going to basically say, okay, we know what the revenue is going to be going forward, and we know what the accounts receivable days are going to be going forward, and therefore we can forecast out what the actual accounts receivable is. And so what we do to get there is we basically say, okay, 100 divided by 365 is the percentage of the year that we've got the deferred revenue or the accounts receivable. And then when you multiply that by the revenue, we get to the dollar value of the accounts receivables. And so that gets us to the 290 here. And then for the other current assets, this one is just a percentage of revenue, super, super simple. So we're going to take that 5.7%, going to multiply it by the revenue here. And then for the accounts payable, what we're going to do is we're going to take the account payable days and we're going to say, okay, that's 1,365ths of a year. And then I'm going to multiply that by the COGS again to say what that is, but I'm going to make it a positive number. So I'm just going to hit a negative sign there. And then all the rest of these are as a percentage of sales as well. So this is, again, pretty simple on these ones. So I'm just going to lock the row for the sales and multiply it by the percentage of sales for each of these. And so we've got these three things here, and that's going to get us to the working capital assets. I'm going to hit Alt equal or Command Option equal on a Mac to do an auto sum formula for the stuff above it. And then I'm going to do an auto sum formula here again, Alt equals the Alt key and the equals key to auto sum the stuff above it. And then we can copy over the net working capital and the increase decrease formulas. Okay, so let's take a look at this together. I'm going to copy this over and then I'll explain what I did one more time here. So basically what we did on the accounts receivable is we took a percentage of the year, multiplied it by the revenue. So we said 100 365ths times the revenue. On the other current assets, we basically did this as a percentage of sales. So we took the revenue times the percentage of sales. Then we add those together for the working capital assets. On the working capital liabilities, we forecast the accounts payable using the days payable method. So we're taking 14 365ths and then multiplying that by the COGS to get to our accounts payable. And then for the accrued payroll and benefits, the other current liabilities, the deferred revenue, what we're doing here is we're doing these as a percentage of sales. So again, pretty straightforward here. Sum that bad boy up, get our net working capital as the difference between those, and then the change between each of those years. Okay, we covered a lot of ground here. I'm just going to show the formulas here. What questions do you all have about this? Feel free to come off mute, raise hand. Love to hear where you're at and what you're thinking about this before we pull it all together with the balance sheet. So stay tuned. I'm really excited. We're about to get to the balance sheet. We're about to bring this all together in a really cool way. But what questions do you have about the cash flow assumptions here before we move on?
Are we gonna get this Excel sheet like after the session?
Yeah, great question, Kakinen. So I'm going to upload this version of the model to the same folder that you currently have access to. Do you have the folder link?
It's in the chat. Yes.
Okay, awesome. So keep that folder link open because once the chat leaves, like you'd have to like email me to get it. So keep that folder link like bookmarked or save it somewhere, and then I'm going to upload this version of the Excel afterwards. So again, if you're not following along perfectly, totally fine. Just watch along, and I'll get it uploaded after to check. Sound good?
Awesome. Thank you.
Yeah, absolutely. Any other questions on the mechanics here of how we did the forecast of the assumptions? And for those of you, I know there's a few people floating in and floating out. So just to recap for everyone who's just joining, so glad to have you here. Go back in the chat and look at the Google Drive link if you want to follow along with the Excel. Otherwise, we've completed the income statement. We've completed the cash flow statement. Now we're going to pull it together in the balance sheet. Questions on the forecast here?
The chart is not visible.
What's that, Pravanch?
I just joined in. I can't see the chat.
Okay, yeah. So let me go drop
Here,
it.
I'll drop it again. I can do it.
You're the man, Tyler. Thank you so much. Appreciate it. Okay, great. So let's move on from here then. Thank you, Tyler and Pravanch. Go ahead, grab that link, download the Excel if you want to follow along a little bit. So we just did the income statement. We just did the cash flow statement. And on the income statement, we ignored the calendarization thing for now. If we have time, we'll come back to that. And so on the balance sheet now, let's start pulling it together. And so the first thing that we're going to need to do is, in order to forecast the balance sheet, for better or for worse, you really need to have the income statement and the cash flow statement handy, because the balance sheet is kind of it's where everything comes together and where all the assumptions that we've been making on the income statement and the cash flow statement converge. So let's start by filling out a simplified income statement. And so I'm going to pop these open side by side again, and you're going to get really good at this linking back and forth between tabs thing. And believe it or not, I know it's boring. I know it's not the sexiest part of what we're doing together today, but it is actually the part that most of your time is spent doing. Like as a modeler, as someone who's an investment banking analyst or a private equity analyst or private equity associate or something, a lot of your time is just linking stuff back up and forth between various tabs, between where you have it and where you need it. So let's start out by linking up the income statement. So I'm just going to take all of these numbers here. And what you're going to notice is we're actually only forecasting out the income statement here, or the balance sheet, like 4 years here. And so we're not going to need everything here. I'm just going to take 4 years of projections. On our income statement, we actually forecasted out 7 years. And I'll explain why we did that once we get to the valuation section. But for now, we're just going to forecast out 4 years of projections. And again, this is an arbitrary choice. You could do 5 years, you could do 7 years, you could do 3. Like, it doesn't really matter depending on what you're using it for. I just want to show you how to do the mechanics. So let's link up the revenue. And the way we do that again is the copy and then Control-Alt-V to get the paste special menu. And then you hit L to link. And it's that one down here. You can click it if you want as well. And again, on Mac, it's Command-Option-V to open up the paste special menu. And if you have accelerator keys, it enables the Alt keyboard shortcuts, but that one's going to be different for the paste special menu. Okay, great. Then next up, the annual growth. For this one, I'm just going to calculate it again because it's super simple. We could also link it up, but in general, I like to calculate because you don't want to have too many links. You want to probably have as few links as possible. And then next up, I'm going to link the gross profit. So I'm going to take the gross profit over here, and then I'm just going to link that bad boy, and then calculate the COGS as the difference between the gross profit and the revenue. And now you'll notice here that the color formatting is a little bit off, and so I'm just going to fix that. I'm going to make this coloring black because it's a formula. I'm going to make this color formula green because it's a link to another tab. So we've got the gross profit, calculate the gross profit margin as the percentage of revenue. And Pravanch, and those of you who are just joining, feel free to use dummy numbers on this since you won't have the income statement built out. And so you can just play around with it and like put in whatever you want for the revenue and the gross profit just to like play around with the numbers. Okay, now next up, operating expenses. We got to copy this over. And so we're going to take the operating expenses and we can take this, we'll copy over those 4 years. And then we'll divide that by revenue to get that as a percentage of sales. And that'll get us what we've got there. So they're spending a ton of money on operating expenses, like 130% of their sales, very unprofitable. But as you can see, it's increasing. It's getting a lot better. And then DNA, we'll do the same thing. So we'll link over the DNA. And then that'll get us to our GAAP EBITDA type thing, which again, as a reminder, you would need to do non-GAAP adjustments for this to be a true EBITDA, but we're doing some simplifying assumptions. And I'm also going to just copy down this formula this time. So we can keep that a little bit easier. Okay. In fact, while I'm at it, I'm just going to copy down all these like percent margin formulas here so that once we populate that, it'll save us a teensy bit of time. So we got all the margin formulas going. And if you don't do the margin formulas, it doesn't really matter. It's just to help us like analyze the statements. Okay, next up, EBITDA. So we're going to take our gross profit minus our operating expenses, but since those are negative, we'll just do a sum and then add in our DNA, and that gets us to our EBITDA. And so the EBITDA here, we'll copy that formula over. And because this is a formula as opposed to a link, I'm going to change that to black. I messed up the formatting on this template, so make sure that that's black if you want it to be perfect, squeaky clean. Okay, so the EBITDA there looks good. Let's just double check that it matches what we have over here. So let's check the 339, 286, 239. Okay, so it looks like it matches up. If we mess this up somehow, like let's say that we subtracted out the operating expenses or something, this would be a really good chance to double check that by comparing it over here and seeing what was matching and what wasn't. Okay. Next up, we'll add in, or we'll subtract out the DNA. Since we've got that up here, I'm just going to do a subtract there. And then I'm going to make that black since we're not linking it. And then, oh, whoops. And then we'll take the EBIT is just going to be the EBITDA minus the DNA. And so since it's a negative, it's going to be plus. And just as a reminder here, EBIT is going to be less than EBITDA because EBITDA doesn't include depreciation and amortization expense. It like sort of adds it back, so it's not including in the expenses. And then we've got our pre-tax income, our tax expense. We'll link those up over here. And then we should be almost there with our income statement over here. And the income statement's going to be very useful to have on this tab because it will be useful for forecasting a lot of the balance sheet items. Otherwise, I wouldn't bother with this. I would just have the balance sheet on this tab. But since we need the income statement to forecast the balance sheet, it's nice to have the income statement on the balance sheet tab sometimes if you're going to be using a lot of income statement driven forecasts. Okay, so the net income is going to be the EBIT plus the pre-tax income plus the tax expense. Let's just double check that this matches up with what we've got. And I think it does not. Oh yeah, it's got to be the pre-tax income plus the tax expense. I don't know why I double added that. That was stupid. Okay, so great. So let's just double check that that matches 338. Good to go. And then that'll be 288. So take that, copy that over, and we should have our net income. Let's just double check that that matches. Looks pretty good. Okay, nice. So we've got our income statement copied over into our balance sheet tab because we're going to need it to forecast stuff. I'll let you all catch up for a little bit here, but let's just see what we did. So first off, the revenue, we linked that over. We recalculated the growth rate. The COGS, we did as the difference between the gross profit and the revenue. And again, if this feels repetitive, that's a good thing because we should be doing this multiple times, building those muscles, building that muscle memory. And then we take the gross margin, or we brought over the gross profit margin, and then calculated the margin. And then for all of these ones that are like margin, basically I just copied those down all at once because everything that's either percent margin or percentage of sales is going to be the same formula. So don't bother typing it out every time. Just link it up properly, copy it over. And then we take our operating expenses, add back the DNA, get to our EBITDA, take out the DNA, get to EBIT, take out our pre-tax income and our tax expense, get to net income. And then we calculate that as a percentage of sales. So hopefully that makes sense. Any questions on copying over the income statement here? Okay, let's dig into the fun stuff then. So next up down here, we've got to start figuring out our balance sheet. Okay, so historically, we're going to need to link it up to the source balance sheet. So let's come over to the source balance sheet on half of our screen and our new forecasted balance sheet on the other half. Okay, so historically, what's our cash and cash investments? Like we're going to have to figure out our assets and our liabilities and equity here. And then we're going to check, you can see I built a check in here, which is basically like, if you subtract this, is it zero? So let's start with our cash and our investments. So we've got our cash and investments, and you can see that there's kind of like two things at least that we're going to be including in there. And maybe even a few things, because that's just our short-term investments. We also have these long-term investments. And so we're actually going to want to add in these three lines together to figure out what our total cash and investments are. And so for 2024, this is going to equal the cash and cash equivalents plus the short-term investments plus the long-term investments. And this is one of the most common mistakes that students make when they're in interviews doing capitalization questions around enterprise value calculations, is they forget to add in short-term and long-term investments as part of like cash when subtracting out cash to get from equity value and enterprise value. And so, for example, when I was at Catalyst, I asked a technical question in the interviews that was related to like short-term investments and long-term investments. And the students who took enterprise value and then subtract out only the short-term investments to get to equity value missed the question because they didn't realize that in fact long-term investments can be liquid and they're usually treated as cash in enterprise value calculations and on our balance sheet for the purposes here. Okay, so we've got our cash. Now what about accounts receivable? This one's pretty simple. We've got that over here. So I'm just going to link up the accounts receivable. Other current assets, this one we just got to basically sum up everything else that we have, which is I think this is just going to be this other current assets bucket. And then we just want to double check, did we get everything that we need to on the balance sheet? So we got the cash, we got the short-term investments, we got the accounts receivable. The deferred contract acquisition costs we don't have on there yet. So we may need to add that in somewhere else. And then next up, we've got the goodwill. Okay. So the goodwill is linked. Now the PP&E and other, this is basically just gonna we're gonna add up everything else that we didn't already add up just to make sure that we've got a full balance sheet that encompasses this stuff. And so this is super simplified, but we're just gonna stick a bunch of stuff into this random bucket here. And that's honestly what you do on the balance sheet a lot of times is you take all of the random miscellaneous items on this very complex balance sheet and you simplify it down to the stuff that actually matters. And so PP&E is going to be the property, plant, equipment. And then I'm just going to add in a bunch of other stuff as well. And so the other stuff that we're going to add in, let's take a look. We probably want to add in some of these deferred contract costs. And then we want to add in this the intangibles. We probably want to add in this this other long-term assets type thing. And then let's go ahead and add in, let's see, do I have everything? Let's also add in this deferred contract current acquisition costs. Maybe this should belong in other current assets, but we've also already got another other current assets bucket. And so I'm just going to stick it in this other assets bucket. And so this is mixing and matching a little bit. It's got a little bit of current, it's got a little bit of non-current, but the real thing that matters is at the end of the day, when we sum this up, does this equal the total assets? Yes, it does. So we're good to go. We've included everything. We've included only once. So while everyone is catching up to that, I'm just going to do Control tilde, and I love to see a fellow Max on the call. So Max, great question. Why do we treat long-term investments as cash? Do we have to consider liquidity? Yes, you do consider liquidity. So for example, if that long-term investment was an investment in a startup that's 20 years away from an IPO, then you wouldn't probably include that as cash. But if the long-term investment is a share of Apple stock that's considered long-term because you're planning to hold it for longer than a year, that's totally liquid. That's one of the most liquid things on the planet. And so it doesn't matter whether it's short-term or long-term. What matters is whether it's liquid or illiquid. Okay, so that gets us our total assets. And I'm just going to copy that over for 2025 as well. And so again, just to make sure that everyone's up to speed on what we did here, the cash is pretty simple. We basically just linked up the current assets or the cash and cash equivalents, the short-term investments and the long-term investments. Accounts receivable is just accounts receivable. Other current assets is just other current assets. Goodwill is just goodwill. And then this other bucket is kind of everything else. And so it's the deferred contract acquisition costs, it's the PP&E, it's the deferred contract acquisition costs non-current, it's the intangible assets, it's the goodwill, it's this other thing. And so it's basically everything else that we didn't include in the first few lines, we're sticking in the last line. It's our catch-all, it's our plug, as they say. And that gets us to the total assets. If this doesn't match, then we did something wrong. And it looks like we might have done something wrong here because the total assets here doesn't look like it totally matches. So what did I do wrong? So cash and cash equivalents, let's just double check this. And if anyone sees what I did wrong before I do, please let me know. I'd love to hear. So let's just see what the add up is. So this is total current assets. So if I take all this plus all of this, I can see that that's going to be 2,406. Okay, so I'm missing about 80 million. Now, where is that coming from? So goodwill, I think, is what's wrong. Oh yeah, because I locked the goodwill calculation. Okay, yeah, so this is where I locked the goodwill, and you can see how that made it a problem. And so that's why you always want to just double check what's going on and double check the totals. Okay, so we got 2,321 and then 2,406. Okay, so that matches. Great. So make sure not to lock it. Oh, yep. Joshua, you caught it. Nice job. Okay, so that gets us the total assets. Perfect. Now let's go take a look at the liabilities and equity. So the first thing we want to link up here is the accounts payable. And so I'm going to take the accounts payable. I'm going to link it over to the 6.7 here. And then I'm going to take deferred revenue. I'm going to link it up to the deferred revenue current and the deferred revenue non-current. And so we've got deferred revenue current and non-current, which is basically just, is it coming due this year or is it coming due in the future? And then we've got accrued payroll and benefits. So that's going to be the next one here. And then we've got other current liabilities, which is going to be this 109. And then we've got the other long-term liabilities, which is going to be maybe this 22. And then we've got the shareholders' equity, which is going to be basically this 1594. It's the sum of like all this stuff above it. And so let's just sum that up real quick and see if we got everything. So that's the 2321 and the balance sheet balances there. So we're good to go on the historicals at least. If we carry this over, the balance sheet balances. And so that's our other check here is like if this didn't balance, we would have messed something up. So for example, if I'd still messed up the goodwill, I wouldn't even need to know whether this was correct. So long as I had this, you can see that this wouldn't balance and I would be able to tell that the goodwill is off by 80 million. Okay, so now comes the hard part, which is forecasting the balance sheet. So first off, we've got to forecast cash. How are we going to forecast cash? Well, that's where the cash flow statement comes back in. And so we've got to come down here to the cash flow statement and link this up properly to make sure that we've got cash ready to forecast. Okay, so the forecast of the cash flow statement is going to look like this. So remember earlier we built this like cash flow forecast statement down here, which has like all the forecast items. Now we're going to link a bunch of that up into like a more formal, traditional like cash flow statement. And so the cash flow statement basically is going to look like this. First off, we're going to link up the net income. So we've got the net income up here because remember that's at the beginning of every. Well, actually, we don't even need to do that historically. I'm just going to do that for the forecast period. So we're going to link up net income up here. And so we've got the 255 million, and then I'm going to link up D&A because that's our non-cash expense. And then I'm going to link up our change in net working capital, which this is going to come from the cash flow statement, our change in net working capital. And since, remember, this is going to be a source of cash, I'm actually going to make this a positive number now. Okay, so look at our cash flow from operations. We lost 250 million. We added back some non-cash expenses of 50 million. And then we had an increase in cash flow from net working capital, which is a decrease in net working capital, but an increase in cash flow. It is a source of cash when net working capital decreases. We talked a lot about that. I know it's confusing, but like try and wrap your head around it. And I'm happy to explain it again. But that gets us basically the total cash from operations here. And so that gets us to the negative 30 million in cash from operations. So hopefully that makes sense for this first part. Now, next up, we've got the cash from investing. And so the cash from investing is going to be composed of the CapEx, which again is going to come from, I believe we've got that over on the income statement. Remember how we calculated the CapEx over here? And then we've got the capitalized software, which again is going to come up there. And so we're just piecing together all the stuff that we've already projected elsewhere, and that's going to be our cash from investing. So we spent a bunch of money on CapEx and capitalized software. And then for our cash flow from investing or from financing, how are we going to do this? Well, realistically, when we look at our balance sheet, we don't really have much debt. Like there's no revolvers, there's no term loans, there's no financing. We're not raising equity, we're not paying down equity. And so the cash flow from financing, we're basically going to hold at zero. Now, if there were any things like stock buybacks or stock issuances or something like that, we'd probably forecast that here. But for now, we're going to keep it very simple. We're just going to say that the change in cash is equal to the cash flow from operations plus the cash flow from investing activities. And so we lost money this year, which makes sense given that we had such like a huge deficit. Okay, so if we copy that over, let's take a look at what our cash flow profile looks like. Well, next year, it looks like we actually start generating cash. And that's largely because our loss decreases and we still have a high increase of cash from net working capital, which largely comes from that deferred revenue that we were forecasting. And so we start to see a cash increase in year 2 that then is going to flow up into the balance sheet. And so our balance sheet is going to basically go year 0 cash flow plus the change in cash. And so we're going to lose a little bit of cash this year, and then things are going to start to turn around slowly where cash is going to increase over time. Okay, now what about this other stuff? So let's go link this up. So our accounts receivable, this is going to go onto the cash flow statement. We already built this out here. Our other current assets, same thing. We're going to link this up here. And then our goodwill, This one, you typically just hold this flat unless you're doing some fancier math on like purchase price accounting. And then our PP&E and other tangibles. On this one, basically, the best way to do this is to say, okay, we're going to take the prior PP&E, we're going to add in our CapEx, and we're going to subtract out our depreciation. So let me just explain what I'm doing here. I've got to make sure I get the signs right. So I'm just going to make sure that that's an addition because we're buying CapEx and then we're also depreciating stuff. And so that should mean, oh, whoops, actually that shouldn't just be CapEx. That should be like all the stuff. Okay, let's just double check that that looks approximately right. Okay, so what's going on here basically is we're basically saying that over time, we've got an investment in new capital equipment. So we've got capitalized software and we've got like physical capital equipment. And then depreciation is eating away at that over time. So picture it like this. Let's say that we buy $100 of factories every year and we have $100 of depreciation every year. Well, the net amount of factories on the balance sheet is kind of just going to stay flat. It's going to be like 100 plus 100 minus 100, 100 plus 100 minus 100. And so it's just going to stay flat. Now, in our case, what you're noticing here is that our depreciation and amortization is actually a little higher than our cash flow, like our things that we're like basically buying, like our PP&E, in this case, CapEx. And so it's physical PP&E and intangible PP&E. And so we're spending about 30 million or 40 or 50 or something like that, 30 million at first, buying new stuff. And it's decreasing at about 50 million a year. And so that means that the net amount is actually going down. So we're investing less in the future than the depreciation is eating away at it. And so our net assets is actually going down a little bit, which is interesting. So let's take this over, let's forecast this out, and then let's copy over this formula, and that should be our assets. So let's take a look at that and just like make sure everything looks like roughly correct. Looks pretty reasonable. Let's figure out if it balances once we do this. Okay, so accounts payable, all of this stuff we've got to link back up to the cash flow statement. So first off, accounts payable, that's going to come from here. So I'm going to link that up. Our deferred revenue, that's going to come from here. So I'm going to link that up. Our accrued payroll and benefits, that's going to be this one. And then our other current liabilities, going to be this one. And then our other long-term liabilities, did we forecast that one out here? I don't think we did. And usually what you do for this is you just hold it flat because again, like we don't really know what this other long-term liabilities thing is. We could go into the financials and look at it in detail. Like we could look in the footnotes of the financials and that would help us. But just remember our principles on forecasting over here. When in doubt, just hold it flat. Like it's the simplifying assumption. Unless you have a reason to believe that it's going to change, the fastest and most accurate and simplest thing that you can do is just hold it flat. And so in this case, let's hold it flat. And Emil's bringing up a good point though, that like if you did want to look into it, we could go and figure out maybe more about what this is. And so let's actually take a field trip back over to the financials for a second and see if we can try and figure out what this like $22 million of other liabilities is. And this will be good practice for when you actually have to dig into it yourself. So let's take a look here. And what I'm going to do is I'm just going to Control F for 21,808. And so that tells us the total other liabilities here. It immediately takes us into what is called the MD&A section, the management discussion analysis, or the footnotes section. In this case, I think this is the footnotes specifically to the financial statements. And so what we see here is a table breaking down what the other liabilities are for that year. And so if we really wanted to forecast this out correctly, we'd go and we'd look at each of these individual components and think about how we wanted to forecast that. So the first thing is operating lease liabilities. Okay. Don't know what that's going to be for this company. So don't really know how to forecast that at this point. Deferred tax liabilities. Also don't know how to forecast that one without more information too. We need to understand the tax profile of the company, their tax rates. We need to understand what their what their net operating assets are and what sort of tax obligations they owe at federal levels, at regional levels, state levels, city levels to really forecast that effectively. And then this other long-term liability. So this is already in the other liabilities, and then they've got another other bucket here where they're not even breaking that out. And so this thing like here, this is truly just like the catch-all within the catch-all. And so we don't know what that 3 million is, and so we probably couldn't forecast that out. And so in this case, when we look at the individual drivers without more information, we probably can't forecast that out that accurately, and therefore hold flat. Okay. Then shareholders' equity. So what do we do with the shareholders' equity? Well, this one is one of the more interesting formulas here. And basically, as you may remember from your interview prep, this is the prior year's shareholders' equity plus the net income minus any dividends. And now in this case, since it's a net loss, not a net income, that's going to reduce the retained earnings. And our total liabilities and equity is going to equal the sum of these things. And so that's going to be that. And the key thing that we got to check is, did it balance? Hey, look at that. We balanced. It's always, this is honestly always the most stressful part of this this entire boot camp that I'm teaching, is I get to the bottom and I'm like, crap, did my balance sheet balance? And yeah, it's 50-50. Like, there's a lot of ways to make mistakes here. If you messed up any of the cash flow forecasts, if you messed up any of the income statement forecasts, the balance sheet doesn't balance. And that's why it's such a good check. But if you followed along properly, looks like our balance sheet balanced today. So let's take a look at those formulas. I'm going to recap it one more time. I'll pause for a second. So what we did here is on the cash and investments, we basically said prior period cash plus the total change in cash. Accounts receivable and other current assets, we linked back to the cash flow statement up here. And then goodwill, we held flat because that really only changes in the context of M&A. And then PP&E and other assets, we basically said it's the prior period plus the stuff we invest in minus the depreciation. And that gets us to our total assets. And then on the liabilities and equity side of things, we linked up the accounts payable, the deferred revenue, the accrued payroll and benefits, the other current liabilities, and the other long-term liability or other current liabilities to the cash flow statement. The other long-term liabilities, we're basically just holding flat. And so we're just keeping it the same as the prior period. And then our shareholders' equity is the prior period plus the net income. And if we paid any dividends, we'd subtract that out. That gets us to our total liabilities and equity. So we've got a draft of the balance sheet. I'm going to stop and take some questions, and then we're going to spend our remaining time talking through how you would use this for valuation. So I'm going to pull open the PP&E and other assets one more time, and then any questions on how to get to this part on the balance sheet. How are you doing? Let's do a quick check-in. If everyone can post in the chat, I'd love to just hear, are you caught up? Are you behind? So say either that you're caught up, you're behind, or like this is too slow or something. So just give me a check-in here. I'd love to hear from you, AJ, Alan, Anastasia, Arseny, Austin, Ania, Emil. Like, is this good? Is this too slow, too fast? You caught up? Okay, awesome. Looks like a few of you are caught up. I'm just gonna keep cold calling names: Emily, Eric, G, Isaac, Jason, Jingru, Josh, Caden, Kalkaden, Long, Luciana, Morgan, Pravanch, Rushmi, Riti, Riley, Ryan, Timur, Tyler. I just want to hear where y'all are at. Okay, so it looks like most of those who are following up are pretty following along. Might be going a little bit too fast for some folks. And so just not to put you on the spot, but Jason, any parts, or Raul, any spots that you want to go back? And then Anya as well. Any parts you want me to cover? And it's totally fine if you're just watching along and you'll go back and get the recording and get the Excel. That's like so fine. But if you're curious about this, like any specific pieces that you want me to go back and look at, and that's totally fine. Totally fine. Arseny as well. Totally get it.
Yeah, can we go ahead for the balance sheet, like the assets thing and the depreciation and whole thing, which you're highlighting right now? So
yeah, let's talk through this because this is one of the more complex things. So in the historical period, remember that this PP&E and other assets, this was kind of just like our catch-all bucket, where we said, okay, what's the PP&E, aka like the factories and all the stuff that we're buying, plus any of the other like potpourri of random assets. Going forward, though, we're forecasting it as if it's just PP&E. So this is a little bit of a simplifying assumption. And what we're saying is the prior period plus whatever stuff, new assets we buy, less depreciation. So let's get back into the definitions of PP&E and CapEx. So the definition of PP&E is it's basically like your stock of capital equipment. It's your property, your plant and equipment. And in the case of a company like SentinelOne, a lot of it's going to be intangible things like the software that they've built. And a lot of it's going to just be like random things that tech companies have, like laptops and a bunch of equipment and company phones and things like that, and furniture and maybe a fancy office building or something. And so every year, two things are happening. One is they're buying new office buildings, and two, the office buildings are becoming less valuable and the furniture is depreciating, the laptops are breaking and things like that. And so the net stock value that goes on the balance sheet is what we had the year before, plus all the stuff we add, minus all the stuff that gets decreased. And so there's a little bit of a balance where it's take the previous, add in new stuff, subtract out new stuff, and you kind of see where it ends up. Now, what's interesting for Sentinel-1 here is the depreciation is higher than their total capital expenditures and like capital software expenditures. And so if you look at it here, the DNA we're forecasting out at 50 million a year, and the total cash from investing, like the CapEx and the capitalized software expenditures, is 30 million a year. And so the net decrease means that that's going down at about 20 million a year, the difference between those two. And so our PP&E and other assets is going to decrease slightly over time. Does that make sense?
So basically, you have last year's PP&E plus the new assets invested minus the depreciation, correct?
Yeah, exactly.
So the reason why I was confused is because you have subtracted both of them, H66 as well as H59.
Yep.
But technically, you're just subtracting the DNA, and since CFI is already negative, negative into negative is positive. Okay, all right.
You got it. Nice job on the math there. Exactly. So you just got to make sure that you're being thoughtful with the signs, because if you understand the concepts, you can make sure that the math works. But if you're just trying to memorize formulas, then it would really throw you off if that's negative versus positive. But for me, it doesn't really matter because I know what's trying to happen. And so we've got to make sure that we're adding in the cash from investing, not subtracting it. Okay, that's great. And then Amy, I totally understand. If we have time at the end, I'd love to go over that shortcut a little bit more because it's nice, but it's not necessary to understand. So you're totally fine. Okay, great. So we've got the balance sheet here, and I just want to recap briefly what we've done and then talk about valuation stuff. So what we did to start out with is we first figured out where to get the information sources. And so we talked about CapIQ and FactSet. I showed you BAMSEC. You can go get a free trial. You can get a free account. Your school might have it if you're in school. And then, of course, there's like the government website that actually has all these financials. You pull the financials and you use that, the income statement, the cash flow, and the balance sheet to start building the model. And so the model, we start out with the income statement here, where we took the historicals, we linked them up and calculated the margins and the growth rates. Then we forecasted out the growth drivers and used that to build the projections. And so the projections here, basically, we projected out and we got to our EBITDA. We got sort of that revenue that's declining asymptotically. We got all the margins basically increasing and a shift to profitability after a few years, which is a pretty common assumption on a lot of these things. Then the second section is we built out some cash flow assumptions. And so this cash flow statement tab, it's not really a cash flow statement, but it's all the stuff that we need to know to get the cash flow statement right. And so we forecasted out the current assets, the current liabilities, some of the key pieces, and ultimately did that to get to the net working capital, which is, of course, the difference between the working capital assets and the working capital liabilities. And we also built out this handy little table here that basically says when liabilities increase, that's a source of cash. When assets increase, that's a use of cash. And the net version of that is basically the same as the assets. That enabled us then to go and forecast out the balance sheet. And so we start out by linking up the income statement, which is just useful to have as a comparison point relative to the other statements. And then we also brought in some of the cash flow statement stuff that we've been working on, and we formalized the cash flow statement a little bit so that it's got those three standard sections: the cash from operations, cash from investing, cash from financing. And we used that, the combined income statement and cash flow statement, to flow into a simplified balance sheet where assets equal liabilities plus equity. Now, what you'll also note here is that it's very common to have some sort of total tab like this that has all of the financials on it. And so even though we built out like separate versions of an income statement and a cash flow statement, it's very, very common in your financial models, move that tab, to have like a summary tab like this that has all of the stuff in one tab, just to make it very easy for your associate or your managing director to look through your model and kind of get it all in one place. And this is also the sort of stuff that you would then output into your PowerPoint. So you'd go and you'd select this entire area, and then you'd copy that and paste that into your PowerPoint. So when you present the deck to the client or to your investment committee, they've got all the numbers in one place. So that's where we've been so far. Now let's go take that and talk about valuation. Any questions about getting up to this point and doing the three-statement modeling side of what we've done? And I want to talk a little bit, of course, about how to go from here and how to keep practicing. Okay. So
Just a question, is this video recorded so that we can look at it in the future for the
I will record it. I'm not going to promise that our video editors might take some time to get it like on YouTube or something like that, but yes, you'll be able to have a recording eventually. I will also upload this Excel file that I'm building right now though, so you can go back and check it, and that's going to be even better than watching a video, is going and trying to like understand what I did by looking at the formulas. Yeah. Okay. So for those of you for whom this was easy, I'm gonna talk about what to do next. Was easy. I want you to do a few things. I want you to go and try to rebuild this from scratch faster. I bet you could do it in less than an hour. And if you can do that, that shows that you're really good at Excel and you understand what's going on. If this was easy, I want you to try to do this with another company. And so I want you to go and find a public company that you are excited about and do the same thing. And that's going to be a lot harder because you have to go collect the data yourself. You have to download it. You have to understand some of the nuances that we didn't discuss here. You're going to have to figure out how to adapt this template and what line items to include and like what goes into COGS and what goes into like the other current assets and the other long-term assets. And so that's going to be significantly harder. And so I'm just going to say that that one is significantly harder. And if you can do that well, then you're probably honestly ready to hit the desk in investment banking. If this was easy, then I want you to add in other complexities. And yes, Raul, you can definitely do other industries for this, like pick whatever you want, go wild, do whatever you're excited about. If this was easy, I want you to add in other complexities. And I'll talk a little bit about this at the end of the session, but I'm just gonna like briefly show you like, oh gosh, where'd I put that? Maybe, oh, I guess I didn't make that tab in here, but there's so many complexities that you could add into this. And so I'm just gonna like type out a few of them. So some of the complexities you could add is like more detailed revenue drivers and expense drivers. That's one thing. You could add in the calendarization versus the fiscal year. You could add in like share counts and EPS. You could add in like basically like a SaaS waterfall for something like this. You could add in detailed tax schedules and NOLs. You could add in more complexity on individual forecasts of the balance sheet and cash flow statement. Like there are so many other things that you could do to make this more complex. And so if this is easy for you, go and try and add some of those things. Now, if this was too hard, let's talk about what to practice from here before we go into the the evaluation section. So if this was hard, I want you to go back and watch the recording once it's posted, and then go back and look at the Excel completed file and try to understand what's going wrong. And then if you're in Wall Street Mastermind, Slack me. If you're not in Wall Street Mastermind, feel free to message me on LinkedIn. Although I'm a little slower on LinkedIn. And then try to do a simplified version of it or just chunks. And so if you couldn't do the whole balance sheet, just do the income statement. If you can't do the cash flow statement, just do like an accounts receivable projection or something like that. Start with individual chunks and try and get it to make sense. Okay, so now let's jump into the valuation. And I'm just going to answer Isaac's question, which is why would you do calendarization? Would it change anything about valuation? Great question, because of comps. Because you want to look at things on an apples to apples basis with comps. I'll talk about that more in a second once we get to comps. So let's go look now at the output section here, which this is going to be the valuation section of our deck. And so I'm just going to scan through these pretty quickly, and we'll spend about 20 minutes on this section going through these 4 or 5 tabs here. And then I'm going to basically hopefully leave a few minutes for final questions and a couple final thoughts. So first off is the football field. And so the football field here, this is one of the most important tabs that we've got in our valuation output, because what it does is it basically says what is all the valuation for everything else, and what does that do for our valuation overall. And so we're going to return to this one. We're going to build this together, but let's go look at each of the individual tabs. So this one here, you can fill this out if you want, but this is like a P&L output tab. We've already done a bunch of that, so I'm going to skip past this exercise for now, but this is more akin to what you'd actually see in like a PowerPoint output. And so a lot of times, again, your job as an analyst or associate is linking things between tabs into the various outputs that people are looking for. Let's go over to the comps though. So let's look at this together in a little bit more detail. So you saw this when it was in the PowerPoint. I'm going to zoom in a little bit using Control Alt equals to zoom in a little bit. And you can do Control Alt minus, or Control Alt plus and Control Alt minus is the best way to remember it to like zoom in and out. So on the Control Alt plus there, let's go look at this. So this is basically the peers for Sentinel-1. So we've got firms like CrowdStrike, Palo Alto Networks, SailPoint, Fortinet, Checkpoint, Qualys, Sentinel-1, Okta, Tenable, Rapid7. And so let's talk about this. So where would you find these? Well, the first ways to find this would be in the MD&A section of the 10K. And so let's go back over to the 10K real quick. I'm just going to Control F for competitors. And so let's look at this here. Okay, so great. So our competitors include the following. And so this is at the top where they talk about like all the risks and the management discussion of the business. And this is only in the 10K. This is probably not going to be in the 10Qs. And so the competition, they give us like a pretty good list of comps here. So they've got CrowdStrike, which we've got. They've got Carbon Black, which is in Broadcom. So we can't include that one probably because it's part of a bigger company. And they've got Trellix, Symantec, which are also part of Broadcom. Microsoft, probably too big to be a good comp. And then you've got other things like Palo Alto Networks, which we do have Palo Alto in here. Okay, so we've got the two main ones that we can include. And then they've got other things like Cisco, which is way too big, and Elastic. So maybe we could consider adding Elastic in here. And then cloud security ones like Wiz that got acquired by Google. Yeah, so that's part of Google. That's too big, so we can't include that. And then, yeah, okay, great. So they basically gave us like a bunch of comps, most of which are owned by larger companies. And so we included the independent ones, and then we added a bunch of other ones ourselves. And so where did these other ones come from? Well, a lot of that comes from CapIQ and FactSet, where we went and like researched, and they basically come up with comps for you. The other place that you get these other comps is through equity research reports. And so a lot of times investment banks like Evercore ISI or like Morgan Stanley or something like that, they've got equity research divisions where they will publish reports on these companies and basically say, here's the competitive landscape, here's what this looks like. Or honestly, what we could do is we could just Google it. We could say, who are the peers for Sentinel-1? And that would enable us to go look at that. Now, Emil's asking a great question, which is like, could you find all of this information in other filings like the 10Q or the 8K? So let's go back and talk about the distinctions between these different filings and why the 10K is your single best source of truth for information about a company. So a 10K is usually something around the range of like 150 pages long. And so you can see that like we were 20 pages, like let's actually look at this. Let's see how many pages this is, just real quick. Indulge me for a second. So this, if we look at the table of contents, it's like 130 pages to get to the bottom. And so this is a long document. It's got business, it's got risk factors, it's got signatures, it's got management teams, it's got management discussion analysis, it's got tables on, you know, non-deductible expenses and like deferred tax assets and deferred tax liabilities. And it's got the income statement, the balance sheet, the statement of cash flows, the statement of comprehensive loss. Like this is a beast of a statement. If we go look at the 10Q in comparison, it's going to be a lot shorter. And so if we scroll through it, yeah, it's long, but it's 90 pages. And so there's like 40 pages of good details in there that are missing. And so they're not going to have like nearly as much stuff. Like what happened to all that stuff on competitors up here? It just skips straight to the financial statements, the financial information, and the tables. And so the 10Q is like a 10K light. And then 8Ks are very, very broad set of things. And so every time a company has a significant news event, they release an 8K. And so they've got other events. They've got like a change in directors, officers, or compensation. So this is basically just a press release saying that they changed the compensation of the chief growth officer and the chief financial officer. Like kind of a waste of your time to be thinking about that. The only 8Ks that I really recommend paying attention to other than important business updates is the quarterly results and financial year results 8Ks. And so in this case, they release an 8K, aka a press release. An 8K is kind of like a press release, to announce that they are releasing their 10K. I know that's weird, but they release one statement, the 8K, to basically say, hey, we're releasing a 10K. And in the 8K, ironically, they sometimes include information that's not in the 10K. I know that's a nightmare. I know it's confusing. I know it doesn't make sense, but you do in general need to look at the 8K for some things and the 10K for most things. So the 10K is the big source of truth. You do also need to sometimes look at the 8Ks. And let me point out a couple of things for advanced modelers here. Emil, this may include you. Things that they include in the 8K that they don't include in the 10K is non-GAAP metrics. So for example, ARR, annualized recurring revenue, a very, very important metric that's not included in the 10K. Or something like a non-GAAP like operating margin. So let's see if they have like a non-GAAP reconciliations down here. So they've got the financial statements, great, yada, yada, yada. And then they've got this whole section on like non-GAAP COGS and non-GAAP gross profit and non-GAAP R&D and non-GAAP EBITDA and things like that. That's really important. We just totally glossed over that today, but the 8K will give you non-GAAP accounting expenses. Okay, so that was a nice tangent. That's where we would get a lot of these from the 10K. We get a lot of these from other information services providers and equity research reports. And then the hard thing is you'd have to go and you'd have to figure out what the revenue, the EBITDA, the market cap, the price is for all of these other companies. And so you know how we just built a financial model for SentinelOne? You'd basically need to build a very small financial model for every single one of these companies. And so this is one of the like most time-consuming tasks in investment banking is spreading comps. Because picture all of the work that we just did to figure out what like the revenue and the EBITDA were for the next couple of years for SentinelOne. If you're really doing comps the right way, you're going to do that by hand for 10 different companies. Now, a lot of the times these days, people automate it by just trusting whatever information services provider gives them. But if you're like a top elite boutique bank and you're doing a multi-billion-dollar deal, you can't trust other people to give you the right numbers. And so you have to go and spread them by hand from the financials. And so you'll go and you'll figure out what the current market price is. You'll figure out what the current fully diluted share count is. You'll calculate the market cap. You'll figure out the cash and the debt. And you'll look for like cash and cash equivalents, and you'll look for short-term investments and long-term investments. You'll look for debt like instruments, and then you'll do adjusted EBITDA, and you'll make adjustments and non-GAAP things to make sure that it's as smooth as possible. Then once you've got all that, you'll want to synthesize it because you need to make sure that you actually understand what the real multiple is that you've got to apply to your business. And so we've got to look at the mean, we've got to look at the median, we've got to look at the percentiles. In this case, probably what we want to focus on is the 2026 median revenue multiple and EBITDA multiple. So if I was just to pick two numbers to pay attention to on this chart, it would be these two numbers here because those are most representative of the future success of the business. Okay, so that's comps. Let's turn our attention now to precedents. So precedents here is a much shorter list. And that's because there just aren't as many transactions that are relevant to a company like SentinelOne out there of scale. And there's only like so many deals that get done every year. And so what we've got here is we've got half a dozen of these right now. ServiceNow, Armis, Francisco Partners, Jamf, Palo Alto Networks, CyberArk, Google Wiz, Turn River, SolarWinds. So let's look at each of these deals in turn. So first off, we're going to notice that there's a big range of size differences. And so these two deals, probably too big. Because if we go back and we look at like, if we go back and look at like the stock or like the market cap or something like that, I'm going to say SentinelOne market cap. Let's go look at it right now. And it's about $5 billion. And so if we're looking for precedents that are $30 billion, that's not super relevant, but it might be the best we have. Okay, a couple other things to look at. The multiples, and I mentioned this in the presentation earlier, are very different. We've got a 3x multiple and we've got a 30x multiple. So our precedence list, honestly, could use some work. It's not that good because we've got this massive range and the 3x is probably too low and 30x is probably too high. Now, take a look at these two deals, Francisco Partners Jamf and Google Wiz, and tell me why those multiples might be so different. Like, let's just post those in the chat. And then, Alan, I see your question. I'll come back to it in just a second. Why might the Francisco Partners deal have such a low multiple relative to the Google Wiz deal? You don't have to know anything about the deals. Just like take some guesses with me about why the transaction premiums and why the multiples might be so different between two different types of deals. Let me ask the question a different way. Why would some company be worth more than another company on a multiples basis? This is a very basic question. If you can't answer this, you're not going to pass your interview. Okay, Alan said strategic versus financial buyer. Great. That's one reason. And so in this case, on one side of things, we've got Google acquiring a company, and the other, we've got Francisco Partners acquiring a company. Francisco is a private equity firm they can't afford to pay a huge premium because they're not going to realize operational strategic synergies in the same way that like a spot or like a strategic acquirer will. So that's a great one. And then in this case, if you knew a little bit more about the context of the deal, you might know that like Wiz was a very strategic asset for Google. And so they were willing to pay a lot more money than maybe it made sense to from a financial perspective to do that. And then Anastasia is bringing up the fact that like at some level you've got leverage limits. And so if you have a massive, massive company, because you can put less leverage on the deal, theoretically you'd be able to afford you wouldn't be able to afford quite as high of a multiple. And so the size of the deal to some extent impacts the capital structure, which impacts the multiple you can pay. That's a very advanced point though. And then Raul, you had a question about it? Or you had a
I
comment?
was going to say a very simple thing, not sure if this is applicable in this context. So when it comes to commercial and corporate banking in Canada, when you have a smaller, let's say small size commercial banking company, so in that case, the maximum a buyer can give, irrespective whether it's a financial buyer or a strategic buyer, the maximum he can give is 3 to 4 times EBITDA. Versus when you look at large size corporation like Loblaws or Canadian Tire or like billion-dollar enterprises, there automatically the EBITDA value or the exit value improves. So there you have like 10 times or 20 times the EBITDA.
Yeah.
So it all
Yeah,
depends upon the sizes of the company based on which the commercial or corporate banker will decide the EV to EBITDA ratio. Yeah.
Yeah, thank you for contributing that, Raul. And so you're exactly right that the larger the company is, ironically, there is a size premium. And so the larger it gets, the larger the premium is. And so a company that is above a certain scale is going to get a normal multiple. A company that's below a certain scale is going to get a discount to that multiple because it's too small. And we can talk about the psychology behind that. But ultimately, yeah, there's a bunch of reasons why one of these deals might be 3x and the other is going to be 30x. And the art of valuation and the reason that you get paid so much as a finance professional is to use judgment to understand which of these is actually applicable to you and your company. Now, luckily, if we take the median, it actually seems pretty reasonable. Like we get rid of some of these outliers like 80x and we get rid of some of the outliers like 3x and we just kind of end up in like reasonable middle multiples or something like that. And so the median revenue multiple is 15 times and the median EBITDA here would be 11 times. Now, that seems like a mismatch. The 11x probably wouldn't make sense. And since our company is unprofitable, we probably wouldn't even look at an EBITDA multiple, but the revenue multiple will certainly be applicable, at least in the near term. Okay, let's go turn to the DCF, and then I want to build this football field together. So the DCF here, in this one, we don't have probably time to build it out too aggressively. And so what I'm going to say is, for you all that are currently following along, feel free to try to follow along. But for this, just like let's just watch, and I'm just going to try and build as much of this as I can, like 5 minutes or something, and I'll talk about what I'm doing as I'm going. So please do not feel pressured to follow along. So basically, on this, what you're going to do is you're going to start out by projecting out the revenue, and then you're going to project out the EBITDA. And in fact, what I'm going to do, I'm not even going to do that. I'm just going to skip down to the EBIT because all that stuff up top, we don't actually really need to build out this. And since we're short on time, I'm just going to skip straight to the EBIT. And so we'll skip to the EBIT, and then we're going to subtract out the taxes. And so we know what the taxes are, and that's going to get us to NOPAT. And so what we're trying to do here is we're trying to get to unlevered free cash flow, which is the basis of a DCF that gets us to enterprise value. And so I'm going to take the EBIT, I'm going to subtract out the taxes, and I'm going to basically get us to our NOPAT. And then once we have our NOPAT, I'm going to add in the DNA, which I'm going to get from here on our income statement. And then I'm going to add in the changes in net working capital, which I'm going to pull from our capital or like our cash flow statement. And so that's going to be this net working capital change thing. And then I'm going to, and remember, since these are going to be an increase, I'm just going to make that a positive here. So I'm just going to flip that sign around. And then the CapEx and capital software, we'll go over to the, where do we have that? Is that going to be on the, it's going to be the cash flow statement. Yeah. Or the balance sheet. And so down here on the cash flow from investing, I'm just going to take that and, well, actually, I'm going to need to go back to the income statement for that one, unfortunately, because we need more years of projections. So what I'm going to do is I'm just going to take that capital expenditure and I'm going to take the capitalized software. And this is basically going to just be a cash outflow in our unlevered free cash flow formula. So remember, the unlevered free cash flow formula is basically EBIT times 1 minus the tax rate to get to NOPAT. You add back the non-cash expenses, you subtract out the increase in net working capital, or in this case, add back the cash flow from net working capital. subtract out the capital or CapEx, and then that's going to get us to our unlevered free cash flow. It's going to be the sum of these things. And I'm just going to do a sum function here because I'm not adding any of the percentages because I'm moving very fast. I'm just like doing a quick and dirty DCF here. And so let's just see what I messed up here. I'm looking at my template just to see if this looks right. So we've got our EBIT. Did I get this right? Operating income. Oh, yep, I copied this over. Yeah, okay, no, that looks good. So 292, and then add in the D&A, subtract out the capital expenditure. Okay, great. Yeah, so this would get us the unlevered free cash flow. So I'm just going to copy this over. And then we've got our cash flow. Okay, great. So if we've got our cash flow, then basically the next thing that we need to understand is like what is the discount period? And I'm just going to kind of ignore too much about this, but we're basically going to say if this is just increasing by 1 year per, you can kind of ignore this. In fact, I'm just going to make this super duper simple. What we're going to do is I'm just going to say I'm going to discount this by half a year. I'm going to discount by a year and a half in the next year. Now, does anyone know why I said the discount period is half a year in 2026 as opposed to 1 year? This is a classic DCF question. Why would I use half a year for the discount period in year one? Exactly. Anastasia, do you explain what the mid-year convention is for us?
Sure. Can you hear me?
Yeah, can hear you just fine.
I mean, I don't know much about it. I think the logic that I understand is that you want to do it mid-year because the assumption is that the cash flows are generated mid through the year. It's just like a simplification that that I use, and also because I guess I don't know if that's flows, but the difference between the valuation date and I think year end.
Yeah. So basically, the core point that you mentioned here is that it's this concept of, and sorry, I'm building out the WACC real quick. I'll come back to this in a second. The concept here is that we don't get the cash flows at the beginning of the year. We don't get the cash flows at the end of the year. On average, we're getting them in the middle of the year. And so if it's currently, January 31st of 2026, and our fiscal year 2027 ends a year from now, on average, we're going to get the cash flows throughout that year. And so the best time to discount it would be as if six months into the year. And so exactly as Josh was saying, we act as if the cash flow happened in the middle of the year to kind of get to that point. And so we're going to discount it by half a year and then a year and a half as opposed to like a full year out, because that would be unduly penalizing them. And so now what I'm going to do, again, I'm moving super fast here. This is just quick and dirty. I'm going to take the cash flows. I'm going to discount it back by 1 plus the WACC, which I calculate up over here really quickly, and then raised to the number of years of discounting here. And so raised to half year. And so what you can see here is that basically took, and let me just make sure I locked the WACC there. I basically just took the 97 million, discounted it back half a year. So now it's like 92 million. And so you can see that the difference between the dollar value and the discount value grows over time as the discounting period increases. And so as we get to year 7 of our DCF or whatever we're doing here, I think this is 7-year DCF. Yeah, 7-year DCF. $800 million of cash flow in the future is only worth $400 million today because of the discounting. And so let's go talk briefly about the WACC here. You guys know the WACC formula. It's basically cost of debt times percentage of debt times 1 less the tax rate plus cost of equity times percentage of equity. And the cost of equity here is the risk-free rate, which I just copied in, plus the market risk premium times the beta. And you can see where I got the beta. These are basically just from a few other different tools. So we've got the risk-free rate, which comes from basically the treasury. And then we've got the risk premium, which comes from a source called Kroll, K-R-O-L-L. And then we've got beta, which comes from like Capital IQ or Bloomberg or something like that. I'm not going to get too much into how to calculate the WACC because that's something that's covered extensively in other videos and guides. But that gets you your discount rate that you then discount back the free cash flow. Okay, so then the last thing that we've got to do here is figure out what our terminal value is. And so there's 2 ways of finding the terminal value. There's the perpetuity growth rate method and there's the exit multiple method. And so the perpetuity growth rate method starts with our terminal year free cash flow. And so in this case, that's going to be the 805 million. And then we've got our perpetuity growth rate. And so our perpetuity growth rate for this one, I'm just going to make it basically equal to this assumption that we have up top. And so I'm going to link it back up to the 3% that we have at the top. And then our terminal value is going to basically be the terminal this times 1 plus the growth rate divided by the difference between the WACC and the growth rate. And that's just a formula. You don't need to, I can explain it if we have a little bit of time at the end, but for now, just memorize that's the terminal value formula for the perpetuity growth rate method. And then to discount it back, we would say, well, we're going to discount this back. From now, it's going to be 6.5 years using the mid-period convention. So I'm just going to take this last one right here. And I'm going to basically say that the terminal value is basically this, divided by 1 plus the WACC raised to the 6.5. So again, you don't need to be following along in Excel here, but what I'm saying is we're discounting back the terminal value at the same level as our final cash flow. And so that's going to get us a present value, and then we take in the present value from this, like the sum of all of these cash flows. And so we're going to say the sum of all of these cash flows here. And then we're going to get to our total value. And what you're going to see is that the vast majority of our terminal or our enterprise value comes from the terminal value. And so this is going to be something like 80% of our terminal value is coming from this. And that's pretty common actually in DCFs. And so don't be alarmed if that's the case. Just note that that's what happens, especially when you have a lot of unprofitable companies. Now the exit multiple method, what you do is you take the terminal value for cash flow or terminal year for cash flow, and then you multiply it by a multiple. Now, in this case, I'm actually going to, I think this is a mislabeled, so I'm just going to call this revenue. I'm just going to make a note for myself to fix that real quick. But so we're going to value this on a revenue multiple at exit. And so we're going to take the terminal year revenue, which is going to be the 800 million here. And then we're going to multiply that by a reasonable multiple. And so we'll come back over to, say, the comps for that one. And so let's go over to the comps and say, well, okay, our median multiple for 2026 is 6.5 times. And so if we take that over to our DCF, let's just assume that that same multiple is going to apply at exit. So we'll multiply the revenue by the revenue multiple. And that means in terminal year, our value is going to be something like this. And then the discount period here is actually going to be 7 times or 7. And I'm not going to get into why that's different between the perpetuity growth rate method and the terminal multiple method right now. If you're curious about that, we can talk about it. That's a nuance of valuation. But for now, just know that for when you're doing the perpetuity growth rate method, you use kind of the mid-year convention. When you're using the exit multiple method, you don't. And if you didn't follow that, that's totally fine. Just do whatever one, and it's probably going to be close enough until you can take another modeling bootcamp from me. So we'll take that. We'll divide by that. We're going to divide by 1 plus the WACC raised to the number of years, which is going to be 7. And that's going to get us that. And then we're going to take the projected cash, and then we're going to sum those together. That's going to get us these. Okay, great. And so we're seeing that somewhere between 3.5 and 5 billion is the current DCF valuation of SentinelOne. And since the current market cap is somewhere in the range of 4 billion or 4.5 billion, I forget, that's actually not crazy. Okay, so the last thing that we need to do together here before I open it up to a couple final questions is we need to tie this back to our football field. So let's take a look at this together here. And I'm just going to link this up such that this chart here works. So first off, on the DCF, we know that the low end of this, on the low end of our range is going to be 3.5 billion. So on the low end of our range, it's 3.5 billion. And on the high end of our range, it's 5.1 billion. So I'm just going to copy those two things over. And again, this is not a part that you need to follow along with, especially since you didn't build the DCF with me. So just watch along for now. And so what this is going to show is that we've got 3.5 to 5.2 billion here. And then I'm just going to divide that by, 10 to the 6 so it fits on the chart. There we go. So now it's in billions. Okay, so now we've got to figure out what the range looks like for the comps and the precedents. And so let's go take a look at the comps and the precedents. So on the comp side of things, if we're looking at this for a revenue multiple, let's say the 25th percentile for 2026 is going to be 4.5 times, and the 75th percentile is going to be 9.4 times. And the reason I'm using the 25th and 75th percentile is that gives us a pretty good range. It gives us a nice range of like, low to high. And so let's take that and let's do the same thing for the precedents where we've got the 25th percentile and the 75th percentile. We probably don't want to do like the minimum and the maximum because sometimes that's too much of a range. But taking the 25th and 75th percentile is pretty common practice for a football field chart for comps and precedents. And so then if we take the revenue for our business for that year, and so I'm just going to go back over to here and I'm just going to link up the revenue for 2026 is $1 billion. And so I'm just going to say on a forward basis, our valuation is going to be on the low end, it's going to be basically 4.5 times this. I'm going to again divide that by millions to get it in the billions. And then on the high end, it's going to be 9.5 times this. And so that's going to be kind of the high end. And then the difference between those two is going to be the gap on the chart. Same thing with precedents. I'm going to take this on the low end, it's going to be 5 times. And then on the high end is going to be this times the 18.9. So you can see that this is just going to be like a massive range on this one in a way that's not the case with the comps and the DCF. And so this is where we got that chart from the PowerPoint here. And this is even a little bit more simple. We don't need to hook up the revenue or EBITDA because the EBITDA is, it's negative right now. And then we also don't need to hook up too much complexity on the DCF since I just did that directly. So this is, this is your football field chart. This is your comps methods, your precedent methods, your DCF methods. And with that, folks, we've accomplished a lot. So I'll have time for maybe 2 questions here, and then I want to leave you with a closing thought and next steps. So what questions do you have about modeling, about financials, about valuation? I know we've covered a ton today. What's on top of your mind? Okay, so Emil's asking, what if EBITDA is up but cash flow is down? Can you explain what you mean by that? And then I'll take Rashmi's question, and then I'll finish with a closing thought. So what do you mean by that, Emil? If you're able to come off mute and explain, that would probably just be easiest.
I apologize. Can you hear me?
Yeah, totally fine.
So in one of my financial classes, it was a question that came up that what if EBITDA, because EBITDA is not equal to cash, what if EBITDA is constantly rising, but your free cash flow is sinking at the same time or not increasing?
Yeah. So why would that happen? Well, there's a few reasons. First off is net working capital dynamics. So if you're having to invest in like a lot of accounts receivable or a lot of accounts like inventory to grow the business, then even if the company is growing very rapidly and like it's got really high EBITDA, it could actually be investing more cash than it's generating, and so therefore would lose. So that would be really bad. And there's a bunch of other reasons, but basically to look at this, look at anything that happens between EBITDA and cash flow or unlevered free cash flow, and any of those things could be a culprit for that. That's a fun accounting question though. Thank you for asking. Now next we had Rashmi's question, which is how do you get better? And so for some of you today, I'm sure this was a walk in the park. Like you were like, hey, I got this. Like this makes sense. Like I did a good job. Awesome. If that's you, we talked about some of the things that you need to do to get even better. And so there's going and actually building out models with a real public company that you go and you source the data yourself. And you go and try and build from scratch and you add in some of these other complexities. And there's a ton more things that I can DM you about in terms of the complexities. If this was really hard though, then I want you to go back and rewatch the recording. I want you to go back and try and understand where you missed the Excel and what went wrong. I want you to ask me questions and try and do simplified versions of this. And then, of course, I host these modeling boot camps every month. And so show up at my next one on LBOs, show up at my next one on Excel and PowerPoint, show up at my next one again, going through this company again. And by next time, a few months from now, when I run this boot camp again, you're going to be a rock star. So this isn't the last time you're going to see this. You can keep revisiting this, and every time you're going to get a little bit better. Great question, though, Rashmi. And then Tyler's asking about the recording. Ask if you tag Juan and Jemima in the Slack, they should be able to should be able to get you the recording before it's released on YouTube. For those of you who aren't in Wall Street Mastermind, I'm sorry, you're going to have to wait until it is on YouTube. Now, Anastasia is asking, why do we have the top left table overall and missing? Let me double check what you're looking at. What are you talking about right now?
Sorry, it's on the like
Football field?
the very first tab. No, it's on the income statement. You have in rows 5 to 9. Yeah, the upcoming fiscal year.
Yeah.
You have like percentage overlap, percentage missing. Like what are those?
Yeah, so that's related to the calendarization stuff over here. We didn't get to that here, but basically, if you were to try and create a calendar version of 2024, you would take 8% of their calendar year, or their fiscal year 2024, and you would take 92% of their fiscal year 2025. And the reason for that is because their fiscal year ends 1 month into the year. And so when they say fiscal year 2024, only 8% of their fiscal year 2024 is an actual calendar year 2024. So it's a little bit of a fun thing.
Is it common practice to do both, fiscal and calendar?
Yes, because in order to truly do your comps right, you need to compare it on an apples to apples basis. Because if these guys have a calendar year 2026, we need to have a calendar year 2026 revenue. And so this football field is a little inaccurate right now because I'm using fiscal year for this and calendar year for comps.
Got it. Super helpful. Thank you.
Yeah, that's a great question. Now, Roll, we've got one more time just for a teensy little one to sneak in. I'll leave you all with a closing thought. What's your question?
Yeah, since I'm interested in like analyzing other industries like healthcare industrial, so where can I get the assumptions for projecting like a brand new company? For example, if I'm looking at a new chain of hospitals like HCA Healthcare in USA.
Good question. So you'll want to go look at healthcare companies, their specific financials and their specific projections, ideally on CapIQ or FactSet. If you don't have projection sources like information services providers for CapIQ or FactSet, sometimes you can find free online equity research reports that talk about assumption drivers for a given industry. But your best bet is just going to be looking at the actual 10Ks and 10Qs that are publicly available for companies in the industry that you're excited about. So definitely take a look at that. Now, I do want to be very respectful of all your time, and I know that we're just a minute out here. And so a couple of things that I'm just going to leave you with is like, first off, I wanted to just say that like what we did today, this was not easy. For those of you who found it easy, that's awesome. That's a testament to your strength here and what you're doing. And so this is something that like I'm really excited to keep building together and keep working on. So if this is hard, absolutely keep practicing it. I promise it's worth it. These jobs are difficult and I'm here to help. So for those of you who are in Wall Street Mastermind already, please ping me with questions. Please follow up. I'm so glad that you were taking advantage of this. For those of you who aren't part of the program yet, please add me on LinkedIn. Message me, feel free to book a call. I'm just going to drop that in there. And if you ever have any questions about your recruiting cycle, about financial modeling, reach out to me. I want to be a resource. So thank you so much, everyone, for joining tonight. Hope you have a great rest of your Saturday. And thank you for spending part of it talking with me about financial modeling.
Max, I have one final question.
I'm so sorry. I do have to hop. Would you mind pinging me on the Slack?
Okay, sure. Thank you so much.
See you, dude. Thank you. Bye-bye.